We'll call the committee meeting on investment advisory to order. I'm not Treasurer Baldwin. I'm Ted Brand. I'm the new Chief of Staff for a while here. I guess I'm also Chief Deputy Treasurer. I worked with Treasurer Falwell previously, and he asked me to be a part of this organization, which I'm very proud to be. So he is expected to be here and hoping to be here. He's on the way, I understand. So before the meeting concludes, we all hope that we see him. So if you would join me now in pledge of allegiance. Pledge allegiance to the flag of the United States of America, to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Salute to the Carlo flag. I salute the flag of North Carolina and pledge to the old North State, love, loyalty, and faith. Okay. I will now ask the secretary to call the roll.
Hey, good morning. This is Ben Garner, General Counsel for the department. I'll take a roll call of the committee members, and then I'll go over just a couple of reminders for our committee members called in. So first, Mr. Anarello. Here. All right. Mr. Copeland. Here. Mr. Patterson. Delighted to be here. Mr. Brewer.
Yes, sir. Here from Wilmington.
All right. Thank you. We do have a quorum. And Mr. Brewer, since you're the only one who's called in, just a reminder, mute your phone when you're not speaking. And if you need to leave, let us know and then identify yourself when you come back on. And we'll proceed as we've always done or over the last year and a half or so. If there's a motion and a second, then we'll count those as yes votes. We'll only be voting on minutes and adjournment. But we have a quorum, so we'll proceed. One thing to note for anyone who's calling in, today's meeting agenda is available on the website for the State Treasurer, www.nctreasurer.com at the Investment Management Division page. And if we lose the phone line connection altogether, which is possible but doubtful, we'll deem the meeting in recess. We'll put a notice on the website, and then we'll reconvene as soon as we're able. All right.
Okay, next we'll ask for approval of the minutes from the previous meeting and ask for a motion. So doing that. So moved. Second. And a second from Mr. Carlo.
I'll go ahead and call the roll then.
Okay, we call the roll.
Mr. Anderson. Oh, I'm sorry.
Is there any discussion? Not hearing any desire. Now we'll call the roll.
All right, Mr. Anarello. Yes. All right, thank you. Mr. Brewer.
Yes.
All right, thank you.
All right. Okay, now next on the agenda is the performance update from Chris, Chief Risk and Operating Officer, F. Smith, with income. Gentlemen.
Welcome. Good to see everyone. We've got a pretty packed agenda with other items with external speakers today, so we're going to kind of buzz through these things since a lot of it we've all seen repeatedly time and time again. Just a quick overview of the markets from the third quarter. Equity markets started out strong, but gave back a lot of the summer returns as we saw rising concerns over the Delta variant and everything tied to that, supply chains, lockdowns, return to school, all the things we've been living with now for a good while, as well as rising inflation, which we're all aware of in our pockets too. We did see domestic markets fare better than global equities. On the bond side, we'll talk some more about fixed income since we're on the agenda later. But generically, bond returns were pretty flat for the quarter. Rates declined early, but then rose back to roughly the levels where we started the quarter. And at the September meeting, we saw the Fed signaling the tapering of bond purchases before year end. On the spread basis, investment grade and high yield spreads were pretty flat for the quarter as well too. So not a ton of movement within that market. Chris.
Very good. Good morning, everybody. Glad to see a lot of your faces in person. If you turn to slide 7, assets under management. Current assets under management at the end of Q3 was 172.8 billion. That was up roughly 1.4 billion from last quarter, which again is another all-time high. The increase from June was mainly due to increased contributions to our cash management program. So that portfolio increased another 1.7 billion. And the other pools were slightly down from last quarter, mainly due to a decrease in the equity markets. Moving on to slide 8. Current asset allocation at the end of Q3. You can see no major changes from the previous quarter. Growth portfolio is at roughly 50%, an underweight of 8%, driven mainly by the public equity portfolio. Rates and liquidity is at just under 39%, an overweight of about 9.7%, driven mainly by the pension cash portfolio. Inflation sensitive is at about 9.5%, slight underweight of 1.5%, which is pretty consistent of where we've been. And then multi-strategies pretty much on target at just under 2%. Moving to slide 9 is a more current picture of where we're at. No major changes to the asset allocation. We've seen equity markets rebound since quarter end. So the portfolio itself has hit another all-time high at just north of 124 billion, and that's roughly where we are today. So we continue to see strong equity markets in general, even though Q3 was slightly down. Moving to slide 10. So our portfolio returns versus our benchmarks. The portfolio is up roughly 0.5% for Q3. Equity markets were slightly negative, as I mentioned. Fixed income was largely flat for the quarter. And the positive performance here was driven essentially all by our alternative asset classes, which all showed positive returns. Specifically, private equity was very strong, as well as kind of our real estate portfolios. We got some good returns from them for Q3. 1-year return is at just north of 15%. Again, driven mainly by the strong equity markets earlier in the year. Given these, our extremely strong returns on a relative basis, you can see that we underperformed by about 1.7% for the year. Looking at longer term performance, you can see that the portfolio itself has exceeded the actuarial rate of return for every time period listed here, which is, the actuarial rate of return is currently 6.5%. So you can see that that's obviously good news, as we can see at the longer term target, and the 20-year number is over 7% currently. Looking at the longer term performance relative to the benchmarks, our plan slightly underperformed the implementation benchmark for the quarter, but outperformed the long-term policy benchmark by about 75 basis points. As I mentioned, underperformed the 1 year by 1.7% due to the strong equity markets versus our kind of conservative asset allocation. We trailed the long-term benchmark on the 1, 3, and 5 year time periods, but look good for the longer term periods. Take a look at Q4. The portfolio is up roughly 2% for Q4 as equity markets rally. Calendar year to date, we're at roughly 9%, with about 6 weeks remaining in the year. So 9% return, certainly north of our 6.5% kind of actuarial target. So barring a big downturn here in the next 6 weeks, we should be in pretty good shape rolling into year end. I'll just hit the next 2 slides real quickly. You guys see these every quarter, no major changes. And as Jeff mentioned, we got a pretty packed agenda, so I kind of want to get through some of these and get to the more meatier topics, I guess. Growth of a dollar chart on slide 11. No major changes here. We kind of tracked this since the inception of our return streams. Pension is still ahead of both of our benchmarks over the long term, which is kind of what we want to see. Slide 12 shows similar charts for the 5 and 10 year time period. And then we added in our alternatives allocation. You can see that the green line there shows that our alternative allocations have added value over the long term. Slide 13 shows our contribution to total plan return for the 1 year ending September. On the right side, you can see how each asset class contributed to the 15% 1 year return. And on the left side, you can see how each asset class contributed to the 17.2 billion of dollars of earnings that we had over the last year. Excuse me. You can see the majority of the returns and the earnings was driven by public equity portfolio, which again had strong 1-year performance, as well as our alternatives as a whole, all performed strong, specifically private equity, which had extremely strong returns for the last year. Moving on to the attribution slides. As I mentioned, the portfolio underperformed the implementation benchmark by about 1.7% for the 1 year. On the top left, you can see that. On the top right, you can see how that's equated between the selection effect, which is how each asset class performs versus its individual benchmark, and the allocation effect, which is how our assets are allocated versus our policy benchmark. You can see that, the allocation effect is what drove the negative performance, as our overweight to cash and underweight to public equities, hurt us for the last year. The selection effect continues to be strong, as many of the asset classes outperform their individual benchmark. Slide 15 shows the 3-year, similar story here. A slight underperformance for the 3-year, about 30 basis points, driven by allocation effect, with again very strong selection effect, as every asset class outperformed, or majority of the asset classes outperformed for the 3-year. On the 5-year, then slide 16, we had an outperformance of about 30 basis points. Again, mainly driven by selection effect. So we continue to see strong performance within each of the asset classes. If you move to slide 17.
So hold on 1 second there on 16. I think Chris mentioned it there, but I do think it's worth kind of stopping and highlighting, because that's something I'm proud of for our whole team, is to see really what you want is good long-term performance from your asset classes go through their benchmark, and to look at the 5-year number and see every single asset class adding value to their benchmark is just fantastic. So that's a tribute to the whole group and everybody contributing. So thanks to the whole team for that.
Great. Yeah, moving to 17. No major changes to this slide for the last quarter. We continue to see kind of both volatility and tracking error decline since the high excess volatility that we saw in 2020. No other major updates on this slide. Let's skip slide 18. No big changes here. We talk about that every time in terms of the downside risk and how the portfolio is positioned. No changes with that. Slide 19 shows our universe comparison. Again, we talk about this every time. More conservative asset allocation than the majority of our peers. So in rising equity markets, we tend to lag, and that's definitely what you see here on the majority of these time periods, where while we've had good absolute performance at north of 15% for the year and north of our actuarial rate of return for every time period that we showed earlier, we do lag our peers given our more conservative asset allocation. On the flip side of that, we are one of the, if not the lowest risk of our peer group, given the more conservative nature of our asset allocation. So you see that on the bottom chart there, where we're typically in the bottom decile in terms of risk. Slide 20 shows same universe comparison with the Sharpe ratio, which is kind of so we were on slide 20, the Sharpe ratio. So again, this is a measure of risk-adjusted return. So it kind of combines both return and the risk that we saw in the last slide. We usually rank pretty high here, given our very low risk profile. And you can see here for the extended time periods, especially, we're typically kind of top quartile. So that doesn't change dramatically. You might see differences on the shorter time periods, especially the 1 year where we were really in a very strong equity market. Slide 21 shows our liquidity profile. Again, no major changes here since last quarter. Our policy states that we want to have at least 70 we can see that roughly 83% of the portfolio itself is valued at least monthly. So most of the portfolio is really up to date in terms of evaluation, in terms of our reporting. But you do have a subset of that, mainly the private equity and a lot of the real estate that's a quarter lag. So I'll turn it back over to Jeff to finish up the day.
Move forward to slide 25, which is the asset class net fees performance. A lot going on, a lot of good numbers on here. I'll kind of highlight a few things. If we look at the 1-year number, obviously really impressive number there for private equity, 57%. Still 20+% public equity, fixed, double digits for non-core real estate, inflation, core real estate. So just a lot of really strong numbers there for the 1 year. And looking across to the 10-year column there, we're seeing double-digit returns for 10 years in public equity, private equity, and non-core real estate. It's really strong numbers. And then the other thing that is always interesting to look at, I've mentioned it before, is we talk a lot directly about private equity, public equity, and getting paid for the liquidity premium and all the work that goes into it as well. And I think when you look over, all the top periods, 3 year, 5 years, 1 year is kind of dicey on comparing those. I think because you got a timing issue that we talked about, but over longer periods, a good measurement there. So look at 10-year public versus private there, and the 15-year. So really getting paid for the work that's being done there, and the liquidity premium involved in that asset class. So a good story that we're getting what we want out of that. Moving on to slide 26. No real surprises here on the far right. And obviously your highest asset classes there are kind of really your growth stories on the top. Private equity, opportunistic, public equity up there, and really at the bottom where you expect to see in a risk-off scenario of a really flat market there, really for cash and for fixed income and multi-strat. So kind of what you expect to see for what went on during the year so far. Moving on to slide 27. In the previous quarter, we haven't really had a whole lot to report on here. We've got a lot of new commitments that are in here on the left. And I'll let just a brief comment, maybe since there's so much on here, from what we've done with private equity with Landmark and BC, and then maybe Ron too. So you want to just make a quick comment, Craig, first?
So the line items that you see under private equity and CL3, as well as under inflation sensitive, that's another platform commitment to Landmark Partners. If you remember the last IAC that we presented, we had talked about how well that was working across the asset classes, in particular private equity. The co-investment vehicle had performed exceptionally well, exceeding expectations. So we actually it's run its course in terms of investments, and we decided to put in place another platform commitment to Landmark across 2 asset classes again. So we were able to use both of our weights to get to save on fees and expenses associated. And it's off to the races right now. We actually have already done 2 co-investments in that time frame. Well, we closed that a couple days after we presented the last IAC. So we expect to have more success with that platform going forward.
And then the remaining 2 asset classes, opportunistic fixed and inflation sensitive, echoes the same story. We leveraged our weight together, our collaboration together, our scale together in order to achieve a really attractive opportunity for the plan collectively. And BC Partners is a private equity and credit shop. So we were able to take advantage of both sides of their organization. And the same thing for Landmark. We're able to take advantage of their private equity arm, and we're able to take advantage of their inflation sensitive arm in a way that works. The last thing I'll say is we're not necessarily trying to do these platform investments every time. We're only trying to do it when it makes sense to use our scale, where it makes sense, and it made sense with private equity and opportunistic fixed.
Thanks, Greg and Ron.
Jeff, quick question. These numbers here on page 27 correlate with the back. We got the orange, it said 3.5 billion, 3.2 billion, 23. These blue lines down here, these are that additional.
So 23 shows the actual cash flows that come out of the portfolio or gone into the portfolio. This shows just the commitments that we're making to it. So these aren't actual cash flows. These are the commitments we're making to these funds. So eventually all those commitments get drawn down and they turn into cash flows.
Right.
But this was about previous 12 months is just looking back in terms of how much has been called. So I think there have been a couple of calls for these. So some of that was in there, but there's kind of two different metrics. One is how much we've committed to the fund and the other is actual flows that have gone to the manager or come back from the manager. Thank you.
Yes, and if you look on the right column with the unfunded, we sat down last time on this, we were like 5.4, so the unfunded's gone up slightly. That reflects kind of the net amount of what's been called versus what the new commitments were as a whole. And that gets captured kind of in chart format on the next slide. So on that note, on page 28, you can see where we are on that for 2021, and really small slight uptick there we have on where we are as a percentage of, really on both numbers there, as total uncalled and also as a percentage of our market value as a whole. So we're still really at low levels, really kind of back to 15 years ago roughly, but that little uptick kind of reflects the items that we just talked about on there, which you saw the returns we've had in those areas. So something that team's excited about, what we were able to get done on that front. So. On slide 29, really nothing new to report there. The asset allocation history, no material changes. Let's skip forward to 30. Only two items here that were exited on the public equity side, kind of smaller.
You're on at the trade.
Yeah. So, and then lastly on slide 31, our top investment managers on here. Looking at it versus the last time, we're never going to see any huge changes, but I can tell you that the 53% internal is up a tick from where we were. 52.2 at last meeting really reflects kind of the run up in the equity markets for the piece that we manage internally. And the overall amounts are just slightly higher than it was before, really because of that piece that was on there. I think all the names are the same except for, I believe Ernest is new in the top 20 versus before, I believe it was Campbell that might have been on the list. That's it. So any questions from the committee members on any of the performance review?
Hearing none. Next on the agenda is asset liability study. Chris, are you in that?
Yeah, it's in the calendar. So John and Jason are going to come up. I'll just give a real quick intro, then I'll turn it over to Callan. You guys can come up if you want. So we talked about in the past that we were undertaking kind of an asset liability study to take a look at our asset allocation with regards to the liabilities of the plan and matching those up as effectively as possible. So we've recently undertaken that, and we've had Callan to help us out with that and with a lot of the modeling that goes into that. So kind of split it up into two meetings. So you're going to see that the first half of it really today, and then the last piece of that at the next meeting in February. So I'll let, if Elizabeth wants to say a little bit, and then we'll turn it over to the guys that did most of the work, I guess.
Thanks, Chris. Just wanted to say a quick hello and introduce the Callan team. So Callan is one of your investment consulting partners. We've actually been working with you all for the past 6 years, but we work a little bit more behind the scenes supporting the public equity team. So Weston Lewis and I, I'm Elizabeth Hood, Weston Lewis and I are kind of the main day-to-day contacts for the equity team. And we're excited to be here today and expand our role a bit, helping with the asset liability study and looking at the portfolio more holistically. So Jason Element and John Perone are members of our capital markets research team. So Jason's an actuary. John's actually worked with the plan even longer than we have in his pre-Callan days at BGI and BlackRock. So has a lot of knowledge and history. So they really they did all the heavy lifting in terms of running the modeling and forecasting. And the goal today, we're working on helping set long-term strategy. So we're not thinking about the day-to-day, quarter-to-quarter, but really setting a long-term strategy that you can be comfortable with, that gives you a framework to operate within, and help achieve the goals over the long term. So we're not necessarily going to try to solve all the problems today. As Chris mentioned, we've been to 2 meetings, but we want to start today with an overview of the process on the work that we've been doing, the capital market assumptions that we've worked out to address the asset side of the equation, and then also we'll take a look at the liability side of the equation and let you know what else is coming in February.
Thank you and welcome.
Thank you, Elizabeth. This is Jason Element speaking. So John and I will have a tag team effort here as we go through the asset liability deck. So, in just the outline of what we'll be covering, this is our first meeting in front of you, and giving you an update on where the asset liability study is at. And we've got quite a bit of information to share at this point. There'll be more to come in February of next year. What we have in front of us today to discuss is first, I'll talk about our process, how we go about conducting an asset liability study. As Elizabeth mentioned earlier, this is the most important investment project you can undertake, right? This is setting the long-term strategic asset allocation of the fund, the most important investment decision you'll make regarding these assets. So there's the process, and then I'll turn it over to John to talk about the customized capital market assumptions. So we worked with North Carolina staff to create assumptions for all the various asset classes yet. These are forward-looking assumptions over the next 30 years. Very, very important inputs into this process, obviously. And then we do have some preliminary results of liability projections. So we do have a liability model. It's still going to be needs to go under some enhancement for the unique funding policy that you have. But we do have some preliminary results we can share with you, and final results will follow in February. So questions, I'll just start jumping in on how we view asset allocation. So that would be slide 2. This is a great concept slide that illustrates how we view long-term strategic asset allocation. Move to slide 1 more. Okay, yes, thank you. So again, this is strategic planning, and so there are 3 strategic policies that govern the fund, and they're highlighted in these ellipses. There's the funding policy. What is the policy for putting money in? There's the benefit policy, what has been promised. And then as investment consultants, we are helping you with the investment policy. How do we invest these assets? And this Venn diagram is shown here because it's illustrating that these policies overlap. So when we conduct a study, we model the funding policy, the benefit policy, and the investment policy. Now, it's the investment policy where we focus on testing different mixes, but we have to consider these other the promises made and the money coming in. And so a classic example of where something in another policy could affect investment policy is the assumed investment return or actual discount rate. You recently lowered that from 7 to 6.5. That 6.5 serves as a bogey, right? You want the fund to beat that 6.5% going forward. Otherwise, investment losses incur and you leads to higher contribution. So that's an example of where there's an assumption made that's in the funding policy section that could influence the asset allocation decision. So it's a very holistic approach we take to conducting an asset liability study. Next slide is a schematic diagram of our process. And it's a process that we've been employing for a very long time. For the full 2 decades I've been with the firm, it serves us well. On the left side of the arm, there is the asset modeling. So as I mentioned, we've developed custom capital market assumptions for the next 30 years, and you're going to see those. John's going to spend about 20 minutes talking about them, going through it in detail. That part's done. We've looked at a lot of different mixes. You're not going to see all those mixes today. There's about 20 mixes we probably have really been looking at, and looking at different capital weights, different asset classes. And then on the liability modeling side, we do have a liability model. And so you'll see some liability projections towards the end of this session. And, there is I want to mention at this point that, your plan actuary employs the same software that we do. It's a software called ProVal. So there's this great synergy that we have where they were able to share some of the code, how the benefits are actually coded. And so that is actually incorporated into our process. So we got a pretty solid liability model because of that synergy with your plan actuary. The plan actuary is Capital McDonald. Now we have asset modeling with liability modeling, right? And we know what we want to do is integrate the two. They need to be properly integrated, because if you have a high inflationary regime, that can mean higher liabilities because it could lead to higher wages. And benefit promises are tied to wages. But what does that mean for asset classes that go through a high inflation regime? So Monte Carlo simulation is this tool that allows us to simulate thousands of different economic scenarios and integrates both assets and liabilities together. Okay, so this is going to give us a wealth of information. We'll see just the tip of the iceberg today in terms of some of the output we can get from that process, from Monte Carlo simulation. But it's very useful, and it gives us a probabilistic nature to the output, because we're across thousands of scenarios. We can, for instance, and we'll see this later. Okay, if the current target mix, what is the probability that we're going to achieve 6.5% over the next 10 years or 30 years? With Monte Carlo simulation, we can get those probabilities. So it's very useful information. Moving one step down is scenario analysis. And this also will resonate very well because there's a number of ways you can develop these scenarios, but we will be looking at high growth, high inflation, low growth, low inflation scenarios, and seeing how different mixes weather those different economic regimes. And the scenario analysis we don't have here today, but that will be. So we get all this information. We got these two tools, simulation, scenario analysis, and we need to compile all that together, assess it, and determine what is the appropriate mix based on all these different variables we get. And contributions obviously will be the main driver, I think. What could happen in a worst case to contributions. So with all that information, we'll assess risk tolerance and arrive at what we think is an appropriate asset allocation going forward over the next 10 to 30 years. So that's a big picture of our process. I'm going to pause there. If there's any questions, otherwise I'll turn it to John to talk about capital market assumptions.
Looking forward to your capital markets.
Okay, thanks, Jason. Yeah, next slide, please. Next slide, thanks. Okay, so yeah, we're going to drill down into the asset side today, capital market assumptions. So what are expected returns for the different asset classes North Carolina invest in, and also thinking about the risk of those asset classes, and importantly, how they interact in terms of the correlations. Okay, and so what we're going to show here today is the projections for both the next decade and for the 30 years. As Jason mentioned, we'll be looking at the planned performance in terms of funding ratio, et cetera, over ultimately a 30-year horizon. And I want to emphasize too that these projections you see today are a collaborative work with North Carolina staff. So we've done multiple iterations, particularly when you get to the alternatives asset classes. It's important to think about how you all actually invest, what your all's historical experience has been, and you'll see when we kind of get into the meat of things that's going to color our forecast here. I thought it would be just the way I wanted to kind of tackle explaining these things. That then you kind of have three different buckets in terms of how you're investing. You're investing in public equities. Okay, you're investing in bonds, and then the alternatives. I'm going to kind of take my remarks sequentially in terms of kind of explaining the modeling we've done here. But I guess a couple high-level messages that if you think about over the next decade in terms of the equity expectations and the fixed income expectations, they're relatively low. And I mean, if you think about fixed income, right, we're starting at historically low interest rates, so it stands to reason that those forecasts will be relatively modest over the next decade. But so I'm going to focus kind of on our central expectations, but I'd like y'all to have back your head that we're not just focusing on the expected return. We're focusing on what may happen, right? So we're focusing on the risk, and that's going to come out in the simulation Jason's are going to run, right? Because sure you care about what's going to happen on average, but obviously you care materially about what might happen in those downside risks where you get down markets, and as Jason suggested, that can provide increased pressure on contributions, right? If you're not hitting your actual discount rate of 6.5. Okay, so the kind of preamble, if you will, let's go ahead and dive in. The next slide is orientation, just in terms of what your all's policy is right now
right? And you see in bold, you guys have segregated the portfolio, if you will, into kind of functional asset classes. So you have the growth bucket, right, which is return seeking. And then in terms of defensive bucket, you have the rates and liquidity bucket, right? The objective there is to mitigate the risk in the portfolio, to diversify the other exposures. There's also inflation sensitive and diversifier bucket that's currently has a policy allocation of 11%. And then lastly, there's the multi-strategy, which is 2%. You could think of that as essentially a hedge fund bucket, right? And so each of those functional buckets, right, are distilled down into individual asset classes, as you can see laid out on the slide there, right? So, and so you can see in the rightmost column, you know, like I said, we're going to talk about equities, we'll talk about bonds, talk about alternatives. That's just kind of a framework in terms of how we're thinking about your asset classes specifically. Okay, so let's go ahead and dive into the public equities here.
Can I say one thing?
Yeah, go ahead,
John,
Chris.
just to make sure everything you see today, you're going to see basically the policy weight allocation. You know, that's just kind of to set the baseline. And then when we talk about kind of all the other mixes, including kind of our actual allocation, which as you guys know, deviate from the policy a bit. So you'll see that at the next meeting where we say, okay, looking at our actual as well as the policy, as well as several other mixes. So just to make sure you all understand, what we're looking at today is really what the current policy weight is, just really to set the baseline for everything else you're going to see later.
Yeah, thanks, Chris. Okay. So let's first start with public equities. And as y'all know, that you invest public equities as a global equity exposure, both the U.S. and international exposure. I think just to kind of motivate the explanation, I think I'll go down and focus in on the U.S. piece of the market. But, you know, remember, there's the global's kind of behind the scenes here. So if you think about return on a stock, right, at the end of the day, you have two income. You have to return from your income, right? So think, dividends, right? And to the extent that there's net share repurchase, that's another way of transferring income back to shareholders. So there's the income piece, and there's capital appreciation piece, right? And that capital appreciation obviously can be potentially colored by market valuations as well, right? The high valuations, you'd anticipate over horizon to get less return than you might in a period where allocation or valuation is more favorable. But so let me just drill down into how we're forecasting the S&P 500 here. Okay, and let's take the income term first. Okay, so we're forecasting dividend yield for the S&P 500 about 2% over the next decade. Another 50 basis points from share repurchases. So that income piece, we're modeling it 2.5%. Okay, and then when we think about the capital appreciation, what we're thinking about is we're thinking about the kind of the economy is a pie, okay? And to the extent there's economic growth, there's GDP growth, that pie is going to expand, and that expansion is going to translate into capital appreciation on the stocks. That's the way we're thinking about here. And so for the capital appreciation component, you want to think of it in nominal terms at the end of the day, because there's going to be a real component, which is inflation. Okay, let me just, in terms of what are we thinking about inflation, kind of hit the elephant in the room up front, if you will. Remember to Elizabeth's remarks that we're talking about projecting over the next 10 and 30 years. Okay, and so our inflation expectation over both those time horizons is 2.25%. And why is it 2.25%? It's driven by a multitude of factors that one, kind of listening to the market. So if you look, for example, at break-even inflation forecast, looking at the Treasury inflation protected market versus the underlying treasuries, that's supportive of 2.25. If you look over 10 years, 30 years. If you look at historical inflation, again, not over, the latest CPI print, but look over a longer horizon, go back over the past 3 decades, 2.25 is supported as well. And then just recognition of the Fed's underlying inflation target, right? That they're targeting 2%, but they've given guidance. They're willing to let the economy run hot a bit, where that. So you kind of take all those pieces together, puts us at 2.25%. And just just to juxtapose that with in your all's actuarial forecast that's embedded in your return on assets assumption, I want to say that long-term inflation forecast is 2.5%. So we're pretty harmonized in terms of our forecast with the actuarial assumption there. Okay. So sorry, so there's a lot, I kind of got sidetracked on the capital appreciation. So we hit the inflation in some depth. And so we have 2.25 coming from inflation, and then another 2.25 coming from real GDP growth. Remember, I was saying that the pie expanding over time. So we're projecting that as 2.25. So you got 4.5 for capital appreciation, 2.5 for income. So that's 7. And then we put an adjustment here for the high valuations of U.S. equity right now. So we shaved that down a little bit to get it 6 3/4 for the U.S. When you kind of fan it out to globally, some of those headwinds that the U.S. faces, particularly in terms of valuation, aren't there. So when you kind of take the forecast and grow it up from a U.S.-centric view to a global view, which again is how North Carolina invests in their policy, we're looking at a hair over 7% on an annualized basis for the global equities over the next decade. And then when you kind of fan that out from 10 years to 30 years, when we move to really longer horizons, we're trying to focus on longer term history in terms of what have the equity markets provided over time. And so if you look at basically all the global equity market, like 25 equity markets where there's history going from 1900 to the present, if you look at all those together, that they've basically returned about 5.25% over inflation on an annualized basis. Again, of this long history over all these different countries. And so that's part of that thinking is what's embedded into our longer term forecast, that, like a 5.25 real is kind of an expectation for the long horizon. So again, short horizon, equities a little bit lower, again, colored by valuation, other effects, and then longer term, the assumption is more kind of reversion to a longer term historical expectation. So let me pause there, because I mean that's obviously key input. I talked a lot without taking breath. So okay, so let's turn to fixed income. And I'd argue fixed income is probably a little more straightforward, because the fixed income, at the end of the day, is kind of a math problem depending on what your forecast is for interest rates. There's really not a lot of play in terms. Numbers kind of are what they are. So yeah, we won't need to get in the weeds here, but in a nutshell, we're taking the current conditions in terms of, as you all know, cash is at 0 right now. You think of the 10-year, the 30-year, pretty low on the order of 2%. So what we're taking that starting assumption, and then we're saying over the next 30 years, again, over the time horizon of a forecast, those yields are going to revert to something consistent with historical expectations. So for example, for cash, you think about cash, if you look over, say, the past 90 years, cash return has been essentially 50 basis points above inflation, if you look at that long-term average. So our terminal cash return in year 30 is going to be at 2.25% plus a 50 basis point real. So that's where that 275 comes from. And again, kind of behind the scenes, so that historical thinking in terms of what things look like over a long horizon is embedded in that. So again, kind of key message, okay, rates are low today. Central projection is that rates are going to increase. So you're going to have capital depreciation on the bonds, and you kind of see that impact when you go to the next slide. And so here you see, and again, North Carolina invests in many different kind of subsets or flavors of fixed income, if you will. And so we see some of those here on the slide. We can kind of top order message, 10-year horizon, fixed income returns quite low. Again, no surprise there. But then as you kind of migrate from 10 years to that 30-year longer horizon, where interest projections, the interest rates can be higher, then you get more favorable returns for fixed income. Okay, so that's fixed income, and then the last piece of the puzzle is the alternatives. And again, as I mentioned up front, the alternatives are this set of asset classes that actually have the greatest deal of customization, because again, we want to be sure we're reflecting how North Carolina actually invests. And so for starters, you think about private equity, we've projected that to have a 2% return premium over global equity. In Jeff Smith's previous presentation, right, he shared that return premium you've got for private equity versus public equity, particularly when you look over the kind of 10, 15-year horizon. So what we've used here, this 2%, is actually somewhat conservative vis-a-vis your all's historical experience. So that's private equity. Real estate.
John,
go ahead,
just what is this part of your collaboration? So that that's where you're coming up with the number as well, or it's just coincidence?
Yeah, so let me make sure I make that clear. So we have a set of base assumptions, but then those are applicable for the public assets. But then, as you're suggesting, when you move into the private assets, that's where you really need, people invest these asset classes differently. So that's where you really need to customize it. And what I'd suggest there is that behind the scenes, there's always kind of fundamental linkage between the expected return and the risk. Okay, so actually I'll give you a practical example here that for public, you have two flavors of real estate. Okay, you've got the public real estate, or excuse me, the core real estate, which is kind of the lower risk real estate. Then you've got the non-core. Okay, so the core we've modeled with about 6% expected return and a risk on the order of 12%. But then since the non-core, there's no free lunch, right? In the sense that the non-core is a higher expected return asset class, but it also has a higher risk because there's essentially so that we model that say with I want to say a 2% return premium, so like 8% expected return for the non-core fixed income, but the risk got scaled up from 12 to 18%. You know, so that's, I'm just trying to give you kind of a specific example of the type of customization. And yeah. Okay. Okay, and you can see for some of the other asset classes, I won't dwell on them here. But again, just really trying to convey more of the flavor of how we're thinking about these things. So putting it all together, actually, why don't we actually go to the next slide, that's the final slide. And so what that's doing is on the vertical axis, right, we're looking at the expected returns for the different asset classes, the horizontal, the risk. And so what I want to show is, again, what I was trying to describe a second ago, that linkage in the returns between the expected return and the risk. You can see the bulk of those asset classes essentially lie in that line, which is kind of showing the trade-off between return and risk. And so I guess one thing I'd say is that there's no magic asset class out there, right, that gives you super high expected return and low risk, right? You can see that they're all look relatively evenly priced, if you will. I guess what I did do was I put the alternatives in there in orange. So you can see if the alternatives, they tend to be slightly above that line. So they have a slightly higher risk-adjusted return than the public asset classes. But that comes at and that goes back to the idea that there's a illiquidity premium, right? So again, there's no free lunch. You're getting a little bit higher expected return at the sacrifice of liquidity. And what I would say, and I think that's linked back to Mr. Morris's discussion, you know, when he showed you all the liquidity profiles, that I'd say that there's certainly ample scope, particularly when you kind of overlay your statutory guidelines, which basically you can only go 35% into alternatives. I'd argue that there is scope to increase that allocation incrementally to alternatives to try to improve, again, the expected return portfolio. And then just to kind of put it all together, okay, so if you take your current policy, you fold it through the projections for the next 10 years. Okay, remember I said low expected return environment, both on public equity, fixed income. We're projecting y'all's portfolio to have expected return of 5.8%, so a little bit below y'all's actual return of 6.5%. But then when you kind of migrate from the 10 years out to 30 years, that your current policy, we're actually getting right at 6.5%. So if you're kind of looking over that long horizon, our return projections are kind of harmonized with what your actual returns are. So let me pause there to that. So I said we kind of want to give you a flavor of the modeling, and then kind of big picture, you can kind of see how those things play out vis-a-vis that royal bogey Jason suggested.
Just want to just define
Yeah.
what risk is in this context, just to make sure everybody understands.
Yeah, so that's, so when you think, we're talking about risk, there's talking about risk in terms of standard deviation or the variability of outcomes around what that expectation is, you know. And again, this may sound a bit like an abstract concept, but again, when we transition into the actual simulation showing you what can happen in good and bad markets, it'll bring that risk concept more clearly to life. And so with that, I'll go ahead and pass it back to you, Jason, to hit the liability side.
Any questions on the capital market assumptions before I?
Help me tie in on page 11, I understand standard deviation. Help me tie that to the percentages you have under the column risk. That's not the standard deviation, is it?
Yes, sir.
That
That's
is
the standard. Yeah, exactly. And so just, yeah, so let's take global equity, for example. So we're expecting an annualized return of 7% a year over the next 10 years. And that risk is 18. So if you had a -1 standard deviation over the event of 1 year, you take that 7, subtract the 18. Yes, you get -11 would be a bad event. And then that negative or positive 21, the 7 plus the 18 would be the positive.
Great, thanks for clarifying.
Yeah, yes, sir.
All right, let's change gears a little bit here, starting on slide 14. And we'll look at some Monte Carlo simulations. And this slide here just gives us a snapshot of where the plan is currently. You see two columns, 12/31/19, 12/31/2020. These are numbers from the actual valuation report.
I'll jump in real quick.
Yeah.
Just so you guys are aware, so this is just the teasers portfolio. So it won't equate to the entire pension plan, the 120 billion that we show. We're just modeling the teachers and state plan, which is the largest plan. The reason we're doing just the one plan is, well, the two large plans, teasers and the local government plan, they're very similar in nature. And we also manage them as one commingled pool. So we need to have a similar investment policy regardless. So when we ran it, we're just running it on teasers. So when you see all these numbers, just keep that in mind. It's not the entire 120 billion, it's the 90 or so that's in teasers.
Thanks, Chris. That's a good point. So, you know, the data we have starts at 12/31/19, so that's our starting point. But obviously, you know, we know what happened in 2020. So we reflect actual investment experience of 2020, which was really good, you know, 11.12% return. And as we continue to flesh out the study, we will reflect 2021. We're almost at the end of 2021, and that should be also a very good year as well. So the projections in here have the 2020 investment experience that you enjoyed, and the next set of results in February will have the 2021. So we'll have a 2-year override, and then the simulations will start, right? Let me just take a quick mention of the funding policy. I think we're all aware of the funding policy for teasers. It's pretty unique, where you have this ECRISP, the employer contribution rate stabilization policy, that has now been approved and extended to 2027. And basically, how that works is that the actuary calculates the contribution based on normal cost, the ongoing accrual, and then amortizes unfunded liabilities over 12 years. But that cannot be any lower than the prior year's rate plus 35 bips. So we're going to fully model that ECRISP policy. What we have in these preliminary results is not quite ECRISP. Right here, it's what we do is we just ratchet up the contribution by 35 bips over the next 5 years. That's most likely what's going to happen. But when we build out the funding policy a little better and capture potential for a big spike in the actual contribution, we'll have that variance in our projections. So
clarification.
Yeah.
Teasers versus the Elchers on the ECRISP. when you do that, when you model that, will it be assuming that it goes away?
Yes.
So because the County Commissioner Association, the League of Municipalities, and the working group that works on the Elders plan fully anticipates that going away. So you won't model it as if it's perpetual.
Yeah, that's a great question. And so, correct, we are going to model the ECRISP continuing to 2027 and then sunsetting. It'll stop. And, obviously it has only been approved to that date. So that's reason number one. Reason number two, though, is that, this policy of continuously ratcheting up, and then applying that over a 30-year horizon would just lead to too much contributions being put into the fund in most scenarios. Because you're, 35 bips increase every year for the next 30 years. That's going to be a very high rate at the end of 30 years, right? So reason number two for just stopping it at 2027.
And tying that back into the previous report, nothing that you've shown in the previous report would say that there's a high likelihood of achieving even the 6.5% rate of return over the next 30 years.
Yeah, we'll see a great slide on that where I'll show the probability of achieving 6.5 over 10 years and 20 and 30 years. And there's not a really, really high probability of it, but there's a 50-50 chance. I'll tell you right now, 50-50, based on our assumptions, the assumptions that we created, right? Those are based on the capital market assumptions that we're using over 30 years. There's a 50% chance you'll hit 6.5 over 30 years of the current policy. So other more aggressive mixes would have a higher probability, but they'd come with no risk.
We kind of tie all this back together. If you don't hit your 6.5% rate of return, and you don't want the fundedness of the plan to fall, then there will be a need for more ECRISP.
There'll be a need for more contributions,
which is right.
And you could smooth those contributions.
Right.
If you smooth them too much, the money's not going in fast enough to, offset the capital investment losses. But
so the ECRISP could be here longer than we think, or increase contribution rates.
Yeah, it certainly could.
It's one or the other.
It's gonna largely hinge on the funded status of the plan in 5 years from now. I mean, if you're fully funded or very close to it, and you're in good shape now, at on a market value basis, you're 91%. Actual values a little lower, but we look at market value 91%. So you could be in a much stronger position at that point. You probably don't want to keep ratcheting up those contributions. You probably want to, the actual probably work with you to have a different funding policy.
And there's not a difference between 91 and 100, but when you start looking at 9 percentage points on 124 billion, that's a lot of money.
It is a lot. Yeah. Okay. So, and you've made a lot of money in the last couple of years. I mean, diligence. I mean, 11% return in 2020 and 2021. I don't know what it is, but it's got to be double digit.
A return
track. Yeah,
it's about 9% right now.
Okay. So, and then
but that's also they're assuming that the liabilities don't change, or we don't have any positive or negative experience from the liability structure, as well as any changes to the benefit policy, right? If any of that changes, then it all depends on what happens there. So it's not just all on the asset side.
Right.
It has to do with the liabilities and the experience that we're going to have there, and any potential changes to the benefit policy, because those are kind of the three levers, right?
And if people live longer, which we hope they do, and have the ability to retire earlier, which is their personal choice, that would blow the liabilities up even more.
Yes.
Yep. Quick question on the actuarial numbers. How up to date are you in your modeling today? Are they from 2019, 2020? And then when you see them in February, will it be numbers through 21?
Yeah, so another good question. So the most recent actual report as of 12/31/2020. And our data is 1 year older than that. So what we do is we roll forward the assets and liabilities to exactly match the most recent actual position. So we are matching at 12/31/2020, and in February we'll still be at matching at 12/31/2020. I know we won't, because what we'll do is we will reflect actual experience, investment experience for 2021. And we'll just roll forward the liabilities based on the actuarial assumptions. We won't know the exact measurement of that liability at 12/31/2021 until after February. But, you know, in the absence of any changes to those actual assumptions, we should be very close. But capturing what happened on the asset side is important, right? But that 2021 was a good year. So we're going to capture that, start simulations at 1/1/2022.
Jason, you may get to this, but with your Monte Carlo simulation, did you also look at if there was a change in the modeling, i.e. a change in the asset allocation, that if it went up public equity by 3%, what does that do to the probability? Is that type of calculation done as well?
Yes, it's not in here. Okay. For today's, not within scope today, but we have run the Monte Carlo simulation model across a number of different mixes. We weren't quite ready to share some of that information because we still need to fine tune that funding policy, finalize those results. But yeah, and when we come back in February, we'll have a various number of mixes run through Monte Carlo simulation. So you'll be able to contrast. It's going to be the most important information to get because you'll be able to make the risk reward trade-off. Say, right, okay, if we get more aggressive over the long run, should be rewarded with the equity risk premium and all those other risk premiums. And it's an expectation that we'll do much, much better, increase the probability of things can happen. But of course, the markets don't always cooperate, and there'll be a worst case scenario, and we'll get into that very soon, where having all that exposure to equities and other high volatility asset classes hurts you. We'll get a little flavor for that with the current policy. But we won't have the variance to look at different mixes to see more aggressive, more conservative. But with current policy alone, you'll see, you know, there's a wide distribution of outcomes of what could happen for the next 10 to 30 years.
Thank you.
Okay, so I'm going to walk through some of the preliminary results. 16 or 15, I should say. Just kind of teeing up the simulation here. It was an open plan. So when people retire, terminate, become disabled, you know, those people are replaced. We have new hires that come in, and that kind of maintains the workforce. So we have 305,000 active members. This is just teasers, and we just maintain that. So there's no change in workforce. So this is an open plan. We have all these new hires coming in to replace any exits out of the plan. Average age hovers around 45, so it's kind of a, you know, the equilibrium here in terms of new people retiring and new people coming in. All right, so moving to 16, you do give ad hoc COLA. You grant that COLA, you know, based on your discretion, or and it's linked to investment performance. And so this is kind of an unknown for us, right? Like how much COLA is going to be promised in the future. And so we came up with, you know, just looking at the last 10 years of history of what COLA has been provided, kind of use that information and say, okay, well, it looks like you're going to be maybe granting 1% COLA every 3 years or so, roughly. So that caused the liability increase. We are baking some ad hoc COLA into the liability projection here, and it's quantified here in the graph here, the red versus the green line. It causes the liability to increase a little bit more.
Maybe just Sam's not here, but maybe someone else could help with this. General Assembly just started passing a budget of the last 24 hours, and at least in this budget, and I guess the last budget, it's been more of a supplement than a COLA. So we have the synchronization of elders now being able to grant a supplement, where previously that went in the statute until about 2 weeks ago. So I don't speak for the General Assembly, But it seems like the last couple of things they've done regarding this issue have been supplements that they paid for. So correct me if I'm wrong.
I think that's right.
Okay, so if they're going down the road over the next 10 years of supplements, not COLAs, that they pay for and we're not amortizing or funding, how would that change what you just said?
So the supplement is not being paid out of the fund, is that right?
Correct. It's being budgeted, paid separately. So it wouldn't.
So then I wouldn't reflect it at all, right?
But if you're assuming it's going to be 1% every 3 years, then what you said, you say there's a, you forecast in this that there could be a 1% COLA about every 3 years.
Yes, correct.
Okay. So if that doesn't, let's just be more clear. If that didn't happen, if everything going forward is a supplement paid for fully by the General Assembly and not taking any money out of the corpus, how would that change the liability?
Yeah, okay. So yeah, I was thinking the supplement as an addition to this COLA, in which case if it's not paid for the fund, ignore it.
One
But
time,
if it's
not recurring.
If it's going to supplant this and there's confidence in that, then we should probably not reflect it.
And it essentially would be the green line here. Right?
Yeah.
So it doesn't have a huge effect in the short term. But yeah, as you get farther and farther, obviously the COLAs are fierce.
Yeah. So I mean,
Slide 16.
so we would we could not reflect ad hoc COLA if that's the preference. There's confidence that it will be paid, but
I don't know if there's confidence. I'm not sure. I mean, I guess we can reflect either one.
well, something maybe too.
But has it greatly changed the fundedness of the plan?
No.
All this in the winter.
The ad hoc COLA we're making in here is not material. I mean, you can see it start to, there's a little bit of difference when you get up 30 years from now, but the liability growth rate, so how much liability is going every year, goes from 2.2 to 2.3. It's an extra 10 pips. It's not, it's not going to have a huge impact.
Simply associated with that subject.
Yeah, correct.
That's what I was trying to get at.
All right.
But that's something you need to have in the back of your head.
Yeah.
Because I know that you deal with some concept, mandatory, statutory COLAs, and you have to bake all that in.
17. So now when we do Monte Carlo simulation, we get thousands of scenarios. The way we like to compile all that information together for it to be digestible is through these floating bars and table. So on the top, you have floating bars, which capture 90% of the outcomes. Goes from the 5th to the 95th percentile, and it's by year. And then underneath you have a table. And now since we're going out 30 years, we didn't show every calendar year. We're jumping by 5 years here just so it's easier to read. So just keep that in mind. 1 year on the top, 5 year in the table. And then just one more thing about how to read these graphs and tables. You see highlighted there the blue row, which is the 50th percentile. It's the median. We call that the expected outcome. This is what we expect to happen. It's a 50-50 chance of occurrence. In the kind of salmon color, we have the worst case scenario. Okay, and we have actually two here. We have a 95th percentile and a 97.5. The 95th is there's a 5% chance of this number or something worse than that occurring. And then when you get to 97.5th, which is deeper into the tail, it's a 2.5% chance of occurrence or something worse than that. Okay, so the reason we're highlighting these rows is because there's a risk reward trade-off. The liabilities aren't the best example of this. I mean, it would be more interesting to look at mixes and compare them risk reward. But basically, you know, you've got a reward row in the 50th, and then you got the risk in the 95th and 97th. So maybe there's a variable coming up they'll have a risk reward trade-off that will resonate better than liabilities. But the liabilities are gradually increasing. It's an open plan. They're growing. That's no surprise to anybody. I guess one important assumption here is you know, throughout the whole 30-year horizon, we're assuming 6.5% discount rate. We don't change that 6.5. Despite and that's an important assumption, right? You change, as we know, we just went through that. You went from 7 to 6.5. You saw a big jump in liability. Despite not changing that 6.5, you can still see some variance here. I mean, at the end of 30 years, liability is 178 billion plus or minus 56 billion. Okay, that's quite a bit of variance. Now, when we get to the market value of assets, the variability is going to be 10 times that. So there's some noise in the liabilities because of inflation, how inflation drives wages, which drives benefit promises. But when we get to the assets and it comes to asset class returns and capital market uncertainty, a lot of variability. And we'll see that very shortly.
Just to clarify, so that range number there at the bottom, that's just the 95th percentile minus the 5th percentile.
Yeah, correct. Right. So 18 is the current policy, just to remind us that we're only modeling these variables on the current policy weights, the same weights we saw earlier. So I'll just flip to 19 and look at simulated returns. Okay, so John talked about the capital market assumptions, and for the current we have the current policy here, and a couple takeaways. First of all, there's a lot of variability over 1 year. Right, over any given year, in a 97.5th percentile, a worst case scenario, you could be down, the portfolio could be down 15 to 17%, right? I mean, it's try to diversify as best we can, but there's still a lot of equities and return volatile asset classes in there, so you can still, have a pretty big down here. The second takeaway I would draw your attention to the far right, where we have the compounded returns. So the annualized return over 10, 20, and 30 years. And just in the bottom right there, you can see the probability of achieving a 6.5%. And so John had talked about, where the current economic environment, where valuations are, yields are, and the first 10 years of the projection for returns are not that good. They're pretty low returns. And then as we get further out to 20, 30 years and it's more anchored in long-term history, the returns are a bit better. And so you can see that the probability of achieving 6.5 improves as we look further out. And so it's 42% over 10 years, and it's 50-50 over 30 years. And this is just the current policy. If we run this through different mixes, we'll get different probabilities, and you'll see that in February.
So just to be clear, because we get all twisted up on percentile sometimes.
Right.
So being in the high percentile is good on one of these pages, but it was bad on another.
Yeah, we're gonna flip the worst case scenario up to the top or the bottom, depending on what the variable is. So obviously a negative return is a bad thing, so we put it on the bottom. High liability, a bad thing, right? Put it at the top. So yeah, it'll move around if that was your question. Yeah, so assets are on 20. Okay, and I mentioned earlier that the variability on assets would be much bigger than the liability. And you can see the range in 2050 is 526 million, which is 10 times higher than the liability. So this is where all the risk is. It's the capital market uncertainty. The range of outcomes is very wide. Now, as we go further and further out, those outcomes, the distribution of outcomes gets wider. Over 10 years, it's more narrow, but it's still at, range at 2030 is still 150 million. But some of that variance in outcomes are good outcomes, right? You can see the green bar. I mean, the upside here, investing with a portfolio in the current policy over 30 years, there's some potential here, decent potential here to really grow the fund quite substantially, right? Because we all know most powerful law in the universe is the compounding of returns over the long run, right? Over 30 years, that's a long time frame. You can see that kind of exponential growth of assets. Not necessarily going to happen. I mean, there is a worst case where there's some positive growth, but it's anemic.
So Jason, tying this together, worst case scenario, goes from 30 years from now, we go from 82 billion to 117. There's a 2.8% annualized return in our liabilities to be 260.
16? Yeah. 217, yeah, that's right.
Well, I think we all should make a promise to come here in 30 years, if anybody's here, and see, because this would not be a good scenario.
Yeah, it's a rough approximation to the worst case scenario for the funded status. And so it's actually a nice segue into slide 21 where we can look at funded status. So if we bring the assets and liability together now and look at what we expect for the fund to do, you can see that we expect the fund to do well over the 30 years. That's when I say expect, I'm always referring to the 50th. That's the expectation. That's the expected outcome. And in fact, it looks like there's going to be quite a bit of surplus generated. That's largely a function of the funding policy that you have, where you aggressively amortize unfunded liability. It's a 12-year close, they call it, which means that you take the unfunded liability, you amortize it over 12 years, just like a house, but then you're going to pay it off in 12 years, right? Not 20 or 30 years. So that's what I mean by aggressive. And so there's quite a bit of losses that are incurred in the middle of this project this 30-year horizon, because we have the lower returns of the first 10. So a lot of money gets pumped into the fund, and then we get some good returns in the back 10 years. And a lot of those scenarios that got a lot of the extra cash kind of like take off. And so that's why we're kind of getting that large amount of surplus generated in the expected case there. Now, there are scenarios where you put a lot of money in and, you have just very poor market returns. And you can see in the worst case scenario, funded status could be down around high 60s, low 70s under the current funding goals at the end, basically in the next 15 to 30 years. So this is, I guess, a good example of the risk reward trade-off, right? Now, would be better though if we had other mixes, because you could contrast, what is the reward for doing the current policy versus something more aggressive versus the worst case, because what you're going to see in February when we look at more aggressive mixes is, yeah, the expected outcome looks better, but the worst case is a lot worse. No free lunch.
So in these scenarios, just talk about the contributions there. So these would, like under the median funded status, as that gets over 100, you see those contributions dip down to eventually zero, right? Or to the minimum that's allowed under current policy, right?
Yeah.
There is a minimum now, right? Yeah.
Right. It actually, so the employees put in 6% and the employer rate can't go below that. So there's a 12% minimum rate. And so even if the plan is 120% funded, 130% funded, you're still putting in 12% pay. So that's another factor, in these out years, that you got into a nice surplus position and just keep putting more and more money in. And that's the current funding policy that we modeled. There is that floor there, so I think we'll keep that. But we got flexibility to change it.
In all likelihood, if that were ever to happen 10, 20 years from now, that would obviously probably be changed, right?
Yeah.
We're at well over 100% funded. I'm certain of that.
Or improved benefits.
Right, exactly. Yeah. One of the two. Okay.
Well, I think we went over time here, and I apologize, but I'm pretty much finished with my section. I think, John, you just maybe wanted to wrap it up on themes.
Yeah, sure. Yeah, that's, and you actually just touched on some of these themes. And again, so give you illustrative representations based off the current mix, right? What's going to be interesting is when you start to move that dial in terms of risk, look what happens for an allocation that has more in the growth bucket, less in the rates liquidity bucket, or conversely, less in the growth bucket, more in the rates liquidity bucket, right? Jason's already talked about those trade-offs, right? Obviously the worst case gets worse, the more you put in growth, right? So we'll be able to look at those trade-offs. We also are going to tweak, remember the capital market assumptions where you saw that the bulk of those alternative assumptions were a little bit above that kind of risk reward line. So we're going to look in conjunction with working with North Carolina staff, the implications of potentially tweaking some of those alternatives that I think right now the policy has about 29% alternatives, and y'all's cap is 35. So we're looking at kind of tweaking that a little bit too. So those are kind of the two main themes we're going to look at. And then just on the last slide, just again, we're going to look at these through the dimensions of not just risk and return, but more importantly, marrying it through the liability process. So you look at, for each of these prospective asset allocation candidate mixes, what's the funded ratio look like over time? What do the contributions look like over time? What might that outcome be in different economic environments such as inflation? And so again, the intent is to come back to y'all in February, present this, and help y'all make an informed decision about what asset allocation to choose going forward. So yeah, we appreciate y'all's time.
Good information. Questions? Mr. Treasurer, is this a study that is going to be set for every 3 years, 5 years, when we believe it's needed, 5 years ago?
It's typically done every 3 to 5 years, depending on what changes. Now, again, if you have significant changes in benefit policy or liabilities or capital market assumptions, you may want to do it more often. These things typically don't change year to year that dramatically, especially when you're looking at the long term. So it's normally a 5-year type thing where it makes sense to do these.
Thank you.
Follow up on Greg's question. How many of these have we done?
The last full one we did was in 16. I think we did another one in 13. I've been involved in probably 3 or 4 of them over my 16 years here. So I don't know if there's any other color on that. So yeah, basically every 4 or 5 years.
So I know you're not into hypothetical questions, but for example, when Treasurer Bowles left this office, the plan was 110% funded. So wonder what this would have looked like the day after he left. And then of course, as soon as Treasurer Moore got elected, in a short few months, our country was attacked, the stock market was closed, plan lost tens of billions of dollars. Then as soon as Treasurer Powell got elected, great financial crisis, plan lost $27 billion. What, just generally speaking, how would all this have looked like right before or right after those events?
I think the one biggest thing that will be different is we talked about how important those returns are. Expected return to fixed income would have looked way different because rates were higher.
Right.
So in that regard, the return expectations are much lower than we would have seen back then because that big piece of our assets is much lower expected return. I wouldn't say the risk probably looks very different, but the expected return sure does. So that outcome would have looked on what you would have looked like, probably your preferred asset mix would look a lot different than now. I think would probably be my biggest takeaway.
So my second comment is, or question is, we have crossed the precipice of the number of people paying into this plan is greater than those that aren't. For the first time in state history. So all that's baked in here.
Yes.
Yes.
I had to say that slowly so it makes sense even to me. It doesn't mean that we paid out 463,000 retirement checks last month. We have about a couple 100,000 people who are invested, not yet drawing. So what I just said, and that whatever that I just said about this is going to get worse and worse and worse and worse and worse. So all that, the number of people paying into plan less than those that aren't, that's all baked in here.
I think that's really captured in 15.
Yeah, the slide 15 there shows it.
Okay.
You can see the
active versus inactive members.
Can I ask a question about that?
slide 15.
You're keeping it flat going forward. Yeah. State of North Carolina is one of the fastest growing states. I kind of assume that as the state grows, we get more teachers, cops, firefighters as just a percentage. Just seems kind of odd that you keep the number of people paying in. Not disputing the fact that what the treasurer just said, that we're going to have more and more people drawing than paying in, but just this assumption here seems spurious to me.
So all the plans we work with, I'd say 95% of the time that that's our default assumption, and we just go with constant workforce. There are clients we work with where they know for sure the workforce is going to increase or it's going to be downsized. We got the capability to do that, but I think we would just need input from staff about the conviction that, yeah, indeed the state employment levels are going to increase, and we should capture that. We could if we wanted to.
I think it's just recognizing that, not saying to change it, but recognizing that that might give us a little bit of buffer.
Do we know what the trend is in the active state employees over the last 3, 5, and 10 years? What percentage increase of employment force?
It's not.
It's not up, okay.
Yeah, I don't think we've seen that certainly recently in terms of that. So we'll take a closer look at that. We'll see if anything needs to be tweaked.
To Troy's point, I mean, this graph does show that there are less people paying in the plan than are not.
Yes.
Right.
Yeah.
Which blues higher than the green already.
I mean, if you're pre-funding the plan, which you are, and the fund is in good shape, which it is, then that ratio isn't too conservative. I mean, if you are really poorly underfunded, and then you'd have to worry about, okay, how are we going to fill this big deficit? I mean, is it going to be a combination of the employer and the employees paying more than 6%? So, but you're not in that position. I think at 91 is very strong, and you have a history of putting in the actuarially required contribution and being careful about the COLA, and not overpromising. Plans get into trouble when they overpromise and undercontribute, and that hasn't been your history.
Jason, do you mind the plan member? Oh, I'm sorry, go ahead.
On slide 15, you're showing that the active employees have a constant age of 45. Do you really mean 45? I think our retirees are retiring at younger and younger ages.
Well, so we typically see the average age of active employees be very stable.
Right.
And we just follow what the actuary's assumption is for retirement. So they have probabilities of retiring out at 55, 60, 65. We're just following those assumptions. And I think you just went through an experience study a year ago. Right? Yeah. So it's something we could look at, but
graph looks like that the average age is around 37.
What page is it?
Slide 15.
It's 45, age 45.
It's a red dotted line there.
The average employee age or the average retirement age?
The average age of actives, so people actively working, not the retirements. Okay. That's a number we see quite often. Like if we look at a public fund, usually the average age is anywhere from 44 to 47 or so, and it doesn't unless the plan was closed, frozen, or there's something unique going on with incidents of retirement. It's pretty stable. You should see a trend there.
Matt had a question.
Yep. So everything related to the liabilities, you tried your best to match exactly what Kavanaugh McDonald is doing from their modeling standpoint and all the policies that are in place for the liabilities.
Correct.
So this reflects that as well.
Yes. Yeah. We will match them exactly as of 12/31/2020 in terms of liability, and then we'll simulate the liability from there. But we will reflect 2021 investment experience. The assets actually aren't going to be simulated until the beginning of next year, 1/1/2022.
I'm making us go over time, but I'm just curious in your world. I mean, I can't imagine what your world's like. You probably present to boards like this that are so upside down, there's nothing anybody can do. And then you present to people like us who, the better funded you are, the harder it is to stay better funded. Is that accurate? Does that describe your world?
Well, yeah, we see a wide spectrum of funds in different situations. Some, when you're really underfunded, like say 50, 60%, we can't do much in investment policy. You can get like 15, 20% returns. It's not going to plug the deficit. It's going to have to be contributions going in. So when we get a plan like this, where it's 91% funded, investment policy matters. And this is actually more engaging for us because we know that what type of strategic allocation we're setting here is very important.
Okay. Can I come back to the active worker question? So the assumption of making it flat, wouldn't that be the more conservative approach? Because if you assume it grows, you get more money coming into the plan.
That's why I said that it gives us more buffer. If you're keeping it flat, that it's more conservative. And, you know, if the numbers do grow, then that's just, we'll be better off, right?
No, but the opposite way, actually.
If there's more active workers.
Right now, I think
we would have
right
more
now,
money
yes,
coming in.
because you know your employer percentage is up around 16, and the total normal cost from the ongoing accrual of a new hire is around 12. So yeah, if you added now where you are right now, I would say yes, you'd have more money coming in. And now if that, now when we forecast it out and the plan gets in a strong financial position, all those scenarios that happens, the total employer rate goes to 12. And so then it's just going to be a wash because the cost of a new hire is 12. So there would be no benefit.
Okay, thank you.
Look forward to February.
Thank you for your time. Yeah.
Thank you, Ken. Thank you, guys. Where are we now?
Should be up to CEM, benchmarking analysis.
Okay.
Michael Reed, are you on the line?
I am on the line. Can you hear me?
Are you with us?
Yes. Can you hear me?
Bill, is Michael unmuted?
I am unmuted.
Michael has unmuted himself. It looks like he's talking, and I don't know why we're not hearing him.
Can you hear me now?
Okay. Yes, we can hear you now.
Okay, thank you. Sorry, it might have been an issue with my headset. But thank you very much. I am pleased to be here remotely from just outside of Toronto, Ontario, Canada, to present your investment cost-effective analysis for the 5-year period ending December 31st, 2020. I do want to point out to the committee that all our analysis is on a calendar year basis and not a fiscal year basis, the July over June, that is your standard fiscal year. Next slide.
Hey, Michael, can I just interject real quick?
Sure.
Just to kind of give you a brief overview. Most of you have seen this before. This is an analysis that we do every year. We present to the IC every year, and it's really just to take a look at our costs and how efficient we are in terms of our cost and then our cost effectiveness versus our peers, versus our own kind of benchmark that CEM sets for us. So we continue to see decrease, which is one of our goals. So just wanted to make sure folks kind of understood that, and this shouldn't be the first time you've seen this. So all right, take it away, Michael. Thanks.
Great, thank you. Next slide, please. So yes, you're right. The primary focus of our analysis is cost, but we also like to frame cost within a lens of performance, and specifically value add. Being low cost in and of itself is not necessarily a good thing if it comes to the detriment of performance. With respect to value add, we define that as the difference between your total realized net returns and your total policy returns, where your policy returns are the returns that you would have earned had you been invested exactly as per your strategic asset allocation and earned your benchmark return in each asset class. So essentially, net value add captures both manager added value as well as value from tactical decisions within the fund. You can see on this chart that your overall net returns and policy returns were slightly lower than the US public median, but if you look to the bottom of this slide, you'll also see that your asset risk was below that of the US public median as well. So it was reflective of your lower risk profile in a 5-year period that was largely risk on. From a value added perspective, your net value added of 0.4% per annum over the 5-year period was equal to the US public median of 0.4%. From a cost perspective, I think the story is really quite compelling. Your cost of 28 basis points were below your benchmark cost and one of the lowest cost systems within our US public pension plan database. And this is really a trend that we've seen accelerate with your fund. Your cost almost halved since 2016, going from just over 50 basis points to 28 basis points in 2020. Next slide, please. This is just an overview of our overall database and client base, which forms the basis for our analysis. In 2020, at the point this report was produced, we'd received data from 279 global funds, 158 in the US. Total assets that we benchmark is around 11 trillion US. 4.4 trillion of that comes from US funds. When I'm speaking to performance and returns, the most meaningful comparison for returns and value added is against our US public universe, which consisted of 49 funds. Next slide, please. Next slide, please. Thanks. When we look at cost, however, we like to look against a peer group of similar sized funds. One of the primary reason why we like to look at funds that are similar size is actually that is less to do with economies of scale within negotiating with active managers and more to do with the ability to implement, specifically the ability to implement internally and the ability to implement private assets and have access to private asset opportunities and co-investments that might not be available to smaller funds. While the peer set is not listed on this slide for the committee's benefit, I will quickly list the peers. They are CalSTRS, Florida State Board of Admin, Lucera, New York City Retirement Systems, Ohio PERS, Oregon, University of California, State of Tennessee, State of Wisconsin Investment Board, State Teachers Retirement System of Ohio, Texas Teachers, Virginia Retirement System, Washington State Investment Board, and your own retirement system. You'll see that these funds range in size from just over 60 billion to just shy of 260 billion, with the median size being very close to the size of your fund. Next slide, please. I'm going to start my presentation by looking at returns. Before I get into my comments, I do just want to, for the committee's benefit, outline the box and whiskers diagram that you see on this slide. We'll see several of them throughout this presentation, quite similar in purpose to those charts that you saw in the Callan presentation that just ended, but presented a little bit different from a graphical presentation. So the box itself contains 50% of the overall observed values, the top of the box representing the 75th percentile, so 75% of observed values occur below that line. The bottom of the box represents 25th percentile, with the line running through the box being the median. And that is the point where half the observed values are above that and half the observed values are below. The whiskers are lines that extend from the top and bottom of the box. From the top of the box, they extend up to the 90th percentile. So 90% of the observed values occur below that amount. And the whisker that extends to the bottom extends down to the 10th percentile. The green dot represents your value, with the red line being the peer median. Since we are talking about returns here, the percentiles are of the US public returns. So like I said, your total net return for the 5-year period was 8.7%, which was below the US public median by about 90 basis points. And that is reflective of your lower risk status. In fact, it's quite interesting. If you look at the graph and each individual year, you'll notice that in higher returning years, your green dot is generally below median, whereas in lower returning years, specifically 2018, you had above median returns, which is suggestive that your lower risk asset mix actually did provide lower volatility than the US public, the average US public plan over this 5-year period. Next slide, please. Similar to the previous slide, previous slide, please. Similar to the previous slide, this slide presents your 5-year policy return. Very similar theme as the prior slide. Generally lower than public medians based on your lower risk asset mix. Next slide, please. So on this slide, I'll provide a few more high-level comments with respect to your asset mix and what makes it lower risk relative to our U.S. public average. If you look at the table on the right-hand side there, you can see your 5-year average policy mix as compared to the U.S. public average. Over this 5-year period, your policy mix has been pretty much stable. So that 5-year mix is also reflective of your actual mix for 2020. The primary reason why you had lower policy returns was your underweight to public equities relative to the U.S. public average. Public equities were the highest performing asset class, specifically U.S. public equities. And that also added a little bit to your underperformance as you were slightly underweight U.S. equities relative to the U.S. public average once you count for the fact that roughly 60% of the public average global allocation is also in U.S. equities. So overall, about 25% for the U.S. public average. Your underweight in U.S. equities was countered by an overweight in fixed income, which was one of the poor performing asset classes over this period. So fairly straightforward rationale as to why your policy returns were below the U.S. public median. Next slide, please. So all that really to set the stage for what I said was what we view as the primary metric for judging your performance, to put your cost performance in context. So from a net value add perspective, you were equal to the U.S. public average of 0.4% per annum. So generally, performance in line. You can see year over year, you did have some years, 2019, a bit lower MVA, 2018, quite good MVA. Again, just to reiterate, this is the combination of both manager added value as well as tactical decisions. For this 5-year period, you were generally consistently underweight equities and overweight cash and fixed income relative to policy. So there is a fair bit of tactical decisions in play here. Next slide. Removing those tactical decisions and looking at the asset class level, this slide presents both absolute returns and net value add for 8 or 7 asset classes, which constitute roughly 80% of your overall asset mix. I'd like to draw the committee's attention to the bottom of this slide, which shows the 5-year net value add, and point out that relative to U.S. Public averages, in every asset class except hedge funds and private equity, your realized 5-year net value add was equal to or exceeded that of the U.S. public average. Particularly real estate and natural resources, where your net value add was about 3% per annum higher than that experienced by the U.S. Public average. So all this to say, quite solid investment performance in the past 5 years, which as we move into the cost portion, should allow the committee to kind of view that cost without any caveats around performance, really. So before I go into the cost analysis, are there any questions from the committee with respect to the performance analysis?
I just want to point one thing out. This is Chris.
Sure.
These are CEM's categories. We have to map our investment policy and our asset classes into their specific categories so that they can compare things equivalently across all their peers. So I just want to point that out, that you won't see the specific asset classes we have. Some of them get merged into several different categories, like opportunistic fixed income, for instance, I think is in 3 different categories here. And some of our inflation sensitive are in a couple different categories as well. So these won't tie easily, except maybe the equities, to our asset classes and our returns for our asset classes. So I just want to make sure folks aren't trying to tie these returns to the ones that we present, because they get mapped separately. So total plan's the same, but in terms of the different categories, we have to do a whole large mapping exercise that we have to go through to make sure that it's mapped appropriately within the CEM categories. Just wanted to make sure everybody understood that.
That's a great point. Thank you. Next slide, please. So this slide shows the costs that were used to benchmark your costs against that of your peer group. In total investment expenses of $296.8 million, or 28 basis points. Excluding oversight costs, 27.6 basis points, or just shy of $293 million. A couple of notes here. These costs do include all your investment management and oversight costs, with the exception of private asset performance fees or carried interest. It is optional to include private asset performance fees in the analysis, but most of our client base still does not. And in fact, only around 40% of US public funds report private asset performance fees to us. Further, with respect to private asset classes, with respect to the base fees, we do our best to ensure that all private asset base fees that are reported to us are done on a gross of offset and rebate basis, so before offsets and rebates. We do review the submitted private asset data quite assiduously, and if we notice that the reported level appears too low to be believable, we will ask for verification from our clients, or for them to complete a further survey to justify their low cost base. And if they can't do so, we will exclude their data from our database and include a default amount equal to what we view as a standard level of fees in that asset class. So this is our way of trying to do our best to ensure apples to apples comparisons within the private asset space. Doing so is exceedingly important. I do want to point out to the committee that despite the fact that private asset investments in combination with hedge funds constituted only 23% of your overall allocations in 2020, they made up 80% of your overall investment costs. So you'll see in the next few slides that the costs you pay for private assets and hedge funds really have an outsized impact on the overall cost position of the plan. Next slide, please. Here we can see a 5-year trend of your costs, and I had mentioned at the beginning that your costs had declined quite significantly over this period. So if you look at the chart on the left, you can see your costs there declining from 50.5 basis points in 2016 to 28 basis points in 2020. Most of this is declines in base fees. There was also a decline in performance fees, which isn't necessarily reflective of a decline in performance, but by looking at the table, we can see that that's also due to a decline in the allocations to some of the private asset class, or some asset classes that do generate performance fees, specifically hedge funds. So the table does present reasons why your total cost decreased. The majority of the cost decrease came from a lower cost asset mix. So I had mentioned that your strategic asset allocation had not really changed over the 5-year period. So the figures shown in this section are actually based on actual implemented asset mix, not strategic asset mix. I would like to point out here again that the profound impact that even small changes in allocations to private equity, hedge funds, and real estate can have in the overall cost of your plan. All told, these asset mix changes reduced your cost by approximately 16.3 basis points. You also had a slightly lower cost implementation style, with the predominant factor there being more passive and less active, and this was mainly in US public equity. Lastly, you paid less for similar services than you did 5 years ago. So you were able to reduce your overall cost base in a lot of asset classes, improving what was a positive result 5 years into what you'll see in a couple of slides as an absolutely fantastic result now. Next slide, please. Here we see your cost trend compared to that of the US public average as well as the peer average. It's pretty clear to see from the chart that your steep decline in investment costs over the past 5 years is by no means an industry trend that we are seeing. The US public average, which is shown in the gray bar, as well as the peer average, which is the light blue, you can see their costs have remained remarkably stable over this 5-year period. Next slide, please. Here we show your costs relative to peers in the public universe, and these are costs that are not adjusted for asset mix. Among your peer group, you are the lowest cost peer, and among our US public universe, you're 6th percentile, which means you're the 3rd least expensive or least costly system within our database. Like I said, this data does not adjust for asset mix, so I should point out that a driver of your lower cost status is the fact that your high cost assets, which we define as private asset classes plus hedge funds, essentially constitute 23% of your fund assets at the end of 2020, which was lower than the peer average of 29%. Next slide, please. It is these asset mix differences why we create what we call the benchmark cost. Essentially, we look asset class by asset class at your peers' costs, and the benchmark cost represents what your peers would pay if they had your asset mix. We have calculated your benchmark cost to be 35.9 basis points, which is close to 8 basis points over your actual investment costs. This suggests that you are a low-cost system relative to peers. I'd also like to point out, in the previous slide, I mentioned that it wasn't necessarily an apples-to-apples comparison. The peer median shown on the prior slide was 52 basis points as compared to your benchmark cost of 35.9. So essentially, this suggests your asset mix is approximately 16 basis points less expensive than your average peer. Next slide, please. Here we provide some details as to why and how you managed to be low cost relative to peers. You did have a higher cost implementation style, which led your overall cost to be 3.1 basis points higher than peers in this respect, and I will provide more details on the next slide. But more than counteracting this was paying less than peers for similar services, specifically external investment management costs, which contributed 9.3 basis points of savings. And in fact, as we'll see later, in almost every asset class, your costs were lower than the median peer. And that really demonstrates, I think, a clear focus on making sure that you're getting good value from your external investment managers. Next slide, please. So this slide provides more details on how implementation style impacted your costs. Like I said, overall implementation style led you to be about 3 basis points higher than your peers. At first, we look at the chart on the right. If we compare your overall implementation style to that of your peers, it is really quite similar. You have a slightly higher allocation to limited partnership structures, which is largely offset by a lower allocation to external active. So in a private asset space, that means a lower allocation to core open-ended evergreen funds. You will notice that when it comes to internal management, both internal active and internal passive, your amount of internal management is quite similar, if a little bit higher than peers. Just one note, when you compare your peers to the US public funds, is the amount of internal management your peers have relative to the average US public fund is a lot more. So internal active for peers is 32% versus 10.7 for the US public, our US public database as a whole, and similar difference in magnitude for internal passive. And I think this just highlights the reason why having a good peer group really provides a more robust and legitimate cost analysis. Turning our attention to the table on the left side, I just want to provide some color as to the different components. So firstly, you are more passive, slightly more passive than your peers. This is predominantly in U.S. public equity, which really aligns well with our research. U.S. large cap equity is the one asset class where our research has been unable to uncover any demonstration of consistent value add through active management. Moving to the next item, you have more external as a percentage of your overall active allocations at 55% as opposed to 50 for peers. Normally, this would be expected to be a cost savings item. The reason it's additional cost for you is where you're focusing your areas on in your internalization. Most of your internal management is in U.S. fixed income. In U.S. fixed income, the average savings from going internal versus external is only 9 basis points. Your peers, on the other hand, in general, in aggregate, have more diversified internal programs and internalizing more of their U.S. mid-cap and small-cap allocations, as well as internalizing a little bit of their real estate as well. While the absolute dollars that they're internalizing in these areas isn't as great as the dollar amounts you're internalizing, the cost savings are much greater. In these asset classes, the cost savings are in the range of 40 to 55 basis points as opposed to the 9 basis points that we see in U.S. fixed income. The next item there, less evergreen as a percentage of private assets excluding private equity. So this, in the Callan presentation, they essentially said core versus non-core, and for the most part, that's essentially what this is. A lot of core opportunities are in evergreen or open-ended funds, which are generally lower cost. So you are invested less in these core investments than your peers, particularly in real estate and private credit. Just in general, these the evergreen structures are roughly around 50 basis points less expensive than LP structures, and that's on base fees only. One last comment on here has to do with co-investments. You do slightly less co-investments than your peers at 8% versus 11% for your peers. Not a small, I mean, a fairly small difference overall asset-wise, but I just wanted to point out to the committee that in this area in co-investments, the cost savings are quite substantial. For real estate and private credit co-investments, we generally see savings on base fees of around 100 basis points. For natural resources and PE, they're around 150 basis points. And again, that's just base fee savings. Often co-investments don't attract performance fees, whereas LPs do, and that would make the actual realized cost savings even bigger. Next slide. So this is, I will admit, this is a very dense and busy slide, but I think it's got a lot of really good information. And I would, if you haven't done so in your prep, I think from the committee's perspective, has a lot of great insights in it. I'm going to attempt to walk you through it using real estate as an example. Real estate is roughly halfway down the slide. I just think it provides some good context. So you can see for real estate, your cost is 94 basis points. That's a weighted average cost, which reflects your varying implementation styles in real estate. And then we have the peer median benchmark for real estate, which is 82.4 basis points. So that is the implementation style weighted average cost of your peers. If you cast your eyes down to the bottom of that column, you can actually see that is how asset class by asset class, how your benchmark cost of 35.9 basis points is determined. It's essentially taking those figures for each asset class and multiplying them by your allocation to come up with the benchmark cost. So that's another, so in other words, for each asset class, the figure shown for the peer median benchmark is essentially the benchmark cost in that asset class. So in real estate, you can see, yeah, you were 11.5 basis points more costly than peers on average. The column to the right of that shows your average assets, which were just shy of 7.7 billion. So then the 3 slides to the right quantify the cost savings or excess cost. So due to implementation style, you can see there 12,332,000 of additional cost relative to peers in real estate due to implementation style. You had less, you used core investments less than your peers did, and you also did not internalize any of your real estate and had slightly lower allocations to real estate co-investments. So that's what's leading to that cost. Now, if we go to the next column, the negative 3,466,000 of below cost relative to peers, that is due to having lower LP costs. In fact, your LP costs in real estate are 10th percentile relative to peers. And in fact, I'd like to draw the committee's attention to the sum of this column just in respect of asset management, which is an annual savings relative to peers of 108,338,000. And you can see scanning up and down the column, like I said, in almost every area you are paying less than peers for similar services. In prepping for this meeting, I wanted to put that 108 million in context for myself. So you also engaged us to benchmark your pension administration costs, and I found it quite astounding that 108 million amount is actually those savings are able to cover your pension administration costs more than 5 times over, which I think is quite exceptional that you've been able to realize those savings against managers, because they are savings that you realize year over year. Next slide, please. So this is the final slide I'll cover. I realize I'm running a little bit over time here, and I'll try and keep it here. This slide shows your relative cost to benchmark and your net value add in comparison to that of both the US publics, your peers, and our global universe. So you'll notice that the vertical axis shows net value add. So the horizontal line running through the middle is 0 basis points of net value add, with the upper part being funds that have experienced positive net value add over the prior 5-year period. The horizontal axis is cost relative to benchmark, or excess cost. So the vertical line that runs through separates systems that are below benchmark cost from systems that are above their benchmark cost. So you are below benchmark cost and appear on the left. In fact, you're in the upper left-hand quadrant, which is exactly where you want to be as a fund. And with that, I will end my formal comments, but I would welcome any questions at this time.
Any questions from board members? How about staff? Thank you. Just repeat the one sentence about it covers the duration cost 5 times over. Could you just say that a little clearly, more loudly?
So you are saving. So you're saving $108 million per year relative to peers by paying less for similar investment services. And according to your most recent pension administration report, your annual cost of administrating your pension benefits was, I think it was $18.6 million. So those savings are enough to pay your entire administrative staff and the related resources over five times over.
Okay, thank you. Questions? John? Thank you all.
Thank you, Michael.
See if we get back on schedule.
We'll move on to talk about the fixed income asset class. Don't have as many exciting tales as we did last time we reviewed it, with credit spreads coming down and all that. So we'll try and buzz through these. Get it back to my mind. So, Brett Hall, Assistant Director of Fixed Income. I'll let him hit the first slide.
Sure. So the first slide that we're looking at is the quarterly one-pager we provide to STIP participants on a quarterly basis. And the time period is as of September 30th, 2021. In the first chart, top left, you'll see the historical annualized net cash returns for the STIF portfolio. Just as a reminder, policy of the STIF maturity range is basically overnight to 5 years. The current average maturity on the portfolio is 1 year. That's down from 1.3 years in 2020. So we are navigating a low rate environment, as you guys have heard mentioned earlier today. So, with lower front end rates, we've been reinvesting and redeploying or deploying new funds into lower yielding assets. And as a result, you can see that the STIF rate has declined from 45 basis points back in October of 2020 to 18 basis points as of quarter end. Moving to the pie chart on the right side of the slide here, you'll see that assets are allocated across money market securities. As you'll recall, the repurchase agreements or repo sleeve of the portfolio represents the portfolio cash. And that's basically managed to meet immediate liquidity needs. As of quarter end, we had 1.1 billion in purchase agreements. And just a reminder of the structure, we're mainly doing overnight repo transactions. They are collateralized with treasuries and agencies, so similar risk profile to the portfolio assets, and it's delivery versus pay. Just moving to the right side of the pie chart, you'll notice the U.S. agency sleeve is currently at 15.3%. This is shrunk dramatically from the last time you saw the same slide. And that's really attributable to the type of assets that we're purchasing there are predominantly callable agencies, and basically spreads tightened and asset class look or maybe security type look very much rich. So when we had callables that were called away or new funds coming into the fund, we've basically been putting those in treasuries, and which brings me to the next slice of the pie here, the treasury portfolio. So as you'll recall, we do ladder treasuries on the front end of the portfolio. So we have right now a minimum of $1 billion maturing each month, basically out to a year and a half now versus prior out to a year. In some cases, we have about $2 billion or so where we've kind of parked cash on the front end of the portfolio. So that part of the portfolio is roughly 38 or so billion currently. At the bottom of the slide here, you'll see additional portfolio characteristics for you guys to review. Not a lot of material changes there. Next one. So on this slide, you'll see the short-term rate history. Just as an aside, the assets under management in terms of par basis have grown to 47 billion versus 35 billion a year ago. The red line is the STIF rate. The yellow line you'll see here is also the iMoneyNet composite benchmark. We've also included comparable treasury rates for you guys to make a comparison. As you'll notice on the far right side of the slide here, offshore rates have declined. The STIF rate is currently above other short-term rates. And that's largely due to our ability to invest out the curve and also the slightly positive shape of front-end yield curve.
Very slightly.
It's not much there. So just as a reminder, we rapidly rising rate environment, the short-term portfolio will underperform these shorter rates. So, current STIF rate, as I mentioned, was 18 basis points. The iMoneyNet was 2 basis points as of September 30. The 1031 STIF rate is 15 basis points.
Unusual word for us getting excited about getting 18 basis points versus the alternative, but it is what it is, and we're glad to get it. So, on slide 4, moving on to kind of the core fixed income product. On the top left is a breakdown between our core product and what we have in IG cash. As a reminder, we had set up long-term kind of this 90-10 split to have kind of dry powder for what we thought would be challenges. We talked last time about that occurring. We saw credit spreads blew out. We used a bunch of that money, over $1 billion. Last time we sat down, we had moved it back to 7.5, and as you can see now, we're back over the 10%. So we got the juice from that trade, took advantage of it. You're going to see credit spreads to tighten back in, so we've kind of put it all back. You kind of wait for any kind of cycle on that again. So on the top right, where we are relative weightings in our core fixed income book, the only real notable thing on there is last time we sat down, corporate book was about 3.5. We're a little over that, overweight. That reflected again where valuations were. As those have tightened in, as you'll see in later charts, we pulled that down too. So mild overweight to corporates, and you've seen us actually grow cash even within core a little bit. And that's because of what we think is out there coming on the rate side of things, and just wanted some more positioning in there to benefit from that. And you can see how that translated on the bottom left. The return summary for IG fixed relative, you'll see us ahead on all time periods now. Pretty flat for the last quarter, as I mentioned in the earlier comments. And you can see on the 1 year number, negative 1.1 versus negative 1.8. So, save 70 basis points essentially of excess performance there by the positioning that we have, which we talked about again and again, and where we are on duration and things like that. And if we looked at that number, actually, I went back and looked at we'll have a chart that we do at the end, which shows kind of expected returns based on how rates change over the next 12 months. That number was really right in line with what we thought would happen for this coming year. The difference was reals actually went up more than expected, but we also saw credit compression that kind of offset that. That kind of left us in that kind of right number there. On slide 5, just the allocation again on the top right. You see where we are, corporate allocation, no material changes there. Again, you see that little sliver in there, blue with a high yield. We can buy split rated securities, which could have a composite high yield, or if we have names that got downgrades to that, we don't have forced selling rules, so we can make a decision on where to hold that or not. So that number's kind of been in the range it's been for quite a while. We've seen the duration come down from where it was last time we talked as well, consistent with kind of our methodology right now. Slide 6 captures the changes in the Treasury for the 10 and 30 year. So you see, I just basically graphed it out since we met last, talked about fixed income. Rates basically trending higher, up roughly 90 basis points on the 10 year, about 55 or so on the 30 year, and slightly higher than where these numbers were. We put the deck together, but not too much. Slide 7 captures the yield curve, shape of the yield curve. As Brad mentioned, things are really flat on the front end. We've seen rates increase, so you're basically seeing a steeper yield curve in that short to intermediate part there, going out to roughly 10 years or so. But across the curve, about 50 to 90 basis point throughout the last year. On slide 8, with credit markets, you can see where we were. We talked about the dislocation that we took advantage of back in early 2020. You can see that's all compressed. Then we're basically now, if we look at that September 20 mark, kind of draw a line up there, you can see we've kind of come in more during the last year. And really at 10-year tights, this goes back to September 2011, really at tightest levels we've seen, and really not only high yield and IG corporates as well too. So yeah, not a lot of juice left in that trade. You want to touch on the sectors?
Sure. So we've shown this slide before, as well as both graphs. Basically, we do monitor and track corporate relative value. So what you're looking at here is basically spreads graph relative to ratings categories. So as a reminder, above the line is cheap and below the line is considered rich. On the line is considered fairly valued. So if we looked at this chart a year ago, basically everything just shifted down in terms of spread and looking at the movement there. So autos, cap goods, REITs, they appear cheap. I'm sorry, they appear rich. Leisure sector moved a little bit closer to fair value. I think overall sector spreads have tended to move closer to fair value as well. Energy remains cheap.
It's a little bit of an odd chart because some of these sectors historically will always trade in those kind of spots relative to the line. On it. It's interesting to look at the movement. So I was looking at last night the slide from last year on it. So the scale is much different. The scale last year on the chart went to like 350. And as one data point, if you look at the energy dot there, kind of right on the A2 line on it. So that average energy, I think last year we sat down was around 200. So you see that spread compression that you saw reflected on the prior chart.
So on the bar chart on the bottom, basically you're looking at our relative corporate exposure relative to the index. So this is something that we monitor on a monthly basis. The portfolio is in blue and the index is in red. Overall, we're fairly neutral across all sectors. Some notable changes in terms of increasing portfolio exposure over banking, telecom, and technology.
On to slide 10, FOMC projections. I'll walk you through some what I think are interesting data points here. A lot going on. So this comes out quarterly. If we take a look at the median kind of there on that left side on the columns there and look at the inflation numbers, PC inflation and core inflation, that 2021 number a year ago to the first column in there was south of 2%. So obviously they were a little off on what we thought was going to happen there. And if we look at 2023, we've seen that 2.2 on the PC inflation. That number last time was around 2%. So not seeing a lot of changes there when you go out, but obviously it was a lot different scenario in 2021. And then on that same kind of area, if we look down on that 2023 at Fed funds rate, you can see where that number is at 1, which would reflect material changes from where we are at the 0 level. That number was basically at 0 last time we sat down. So you're seeing a lot of those Fed rate changes kind of being pulled forward with the Fed. Looking at the far right on the ranges, if we kind of look at those inflation numbers, you see reflected there in the 2021 kind of this spike in inflation we're having. But I think it's interesting to look and see kind of what the Fed projections are when we look into that 23 range and 24 range. So they're not signaling really any long-term concerns if you look at the ranges on their inflation numbers. So obviously that's the hot topic on transitory, how long things last, they're going to last, but we're not seeing really it coming up any of the Fed projections that came out in September. Slide 11. This is the dot plot gets released. So I went back and pulled the data again, just as a reference point to last time to walk you through what's on here. Again, the gray dots are the projections from the different members on the Fed as of 2020, and the yellow dot is the last release in September. So you can see basically, again, nothing really going on in 2021. We compare them. You see 2022. Last year, there was really no expected change except for one member. Now we're seeing some kind of some difference of opinions there on that, and a lot of dispersion in 23. So really nowhere near a consensus on what happens there. But we're really seeing kind of data now showing kind of a mid-2022 possible rate increase, and that also would mirror up with the timelines of the taper they announced that started in November, would kind of wrap up in on the current pace around that timeline too. No real changes long term, so reflects kind of what we know is out there. Moving on to slide 12. The top of the thing screen, again, this captures bond yield forecast functionality inside Bloomberg. Just a good place to see consensus, what expectations are on there. If we look at kind of where 30 years are, again, we're starting here at kind of the current rate under market yield and looking forward for roughly 2 years. You're seeing a consensus 2-year move of roughly 100 on the long bond, roughly 90 or so on the 10-year and on the 5-year. So again, that trend towards higher rates that we're seeing out there. If we looked at what the numbers looked like when we sat down last year, looking at that Q4 2022 column, the expectations back then for the 30-year were around 2.25. We're seeing them north of there, 1.5 on the 10-year. So again, we're seeing that being pulled forward on expected rate increase of roughly 50 or so. Bottom half of the chart captures the 5-year TIPS break-even rate. You can see where we trended up there, consistent with showing inflation coming up, and we're popping up now around pushing 3% on that 5-year number, which really reflects kind of what we're experiencing now with a combination of what's expected in those last few years of that 5-year window. That number was 159 when we sat down a year ago when inflation occurred, so just break even. So TIPS have basically done well relative to that for the last year. And then lastly, the last slide, which just has our basic simulation. So all we're really doing is taking the portfolio, giving you different rate change scenarios where we're just shifting the curve up in parallel, a real simple scenario with no changes in credit spreads, kind of getting a feel on what that means like for returns over this just 1 year simulation period. And again, you can see the orange bar there is capturing the income component, which is steady there across time. And then obviously the gray part is the price return and the combination. So if we think about that bond yield forecast expectations being up in that range and us seeing us moves up 25, 50-ish range, it really leaves us kind of back in that, slightly negative flat to 1.5% scenario on it, which is consistent kind of with where we've been. Nothing real material changes here. Again, we're expecting some slightly elevated inflation in the near term. And we're still in that range of 5 years with probably 1.5 to 3. I'd probably say more on the short end of that number. So a little different environment, but there's not really no exciting opportunities I can speak of from the last year. Just kind of the market is what it is, and we're going to see kind of what transpires, obviously, with inflation and Fed's right if it disappears in a year or so on that. That's certainly been the topic in our office a lot. I don't know what we think. Questions?
Anybody at the Fed shopping?
Or getting gas. So
What is the Monte Carlo simulation about Wake Forest versus State football?
well, in hindsight, we know what it was, but
All right. Thank you.
thank you.
Ron, can you make up some time here?
Yes, sir.
Duration is still tight,
We're still short like one.
which is how many years?
A full one. Measured. We usually measure it on effective duration as a percentage change. So we'd be at a 1% change different for 100 change in yields. We're still kind of at the tightest we've been relative to it.
Good morning. Today I have the pleasure to chat with you about the opportunistic fixed income portfolio and how it's performed over the past 1 year and over a longer period of time. Today I'm joined by one of the portfolio managers on the team, Todd Powers, and I'm going to talk to you a little bit about the history of the portfolio construction performance, and Ty will update you a little bit about the current market environment for the fixed income environment. And I will recap with what that means for what we're going to do moving forward. And so slide 2, there are 5 reasons this portfolio exists. Number 1 is attractive absolute returns. 2, competitive relative returns, diversification relative to other asset classes that we have, capital preservation. And I would say that we've been able to achieve these goals over a long period of time. Some of these things are in conflict with one another, capital preservation and also making attractive absolute returns, but I would say we've been able to hit it on the mark over a long period of time. Next slide. Here are the portfolio components and building blocks that we construct the portfolio with. We have what we call special situations, hedge funds, distressed credit, and traditional corporate credit. And on the right-hand side, you'll see examples of strategies that comprise that portfolio. And we pretty much have a mix of all of these things on the right-hand side to comprise our portfolio. And that mix has actually been really good. It's provided diversification we needed, and then also provided opportunities at different times throughout the cycle. Currently, our portfolio is underweight by 1.2%. Relative to its target weight. And we also see that continuing to be the case over the next 12 months, given that we have a significant amount of distributions anticipated from our portfolios. Chris mentioned earlier that the alternative asset classes have generated a significant amount of distributions in 2021, and I don't see that stopping anytime soon. And that's driven by a lot of our assets being in closed-end funds where the managers need to distribute capital at the end of a term relative to open-end products where you continuously invest. So it's definitely something that we're going to need to address moving forward. And we've started to address that to some degree, as you saw some of the slides where we made new commitments to BC partners in the past month. And so we hope that continues, and hopefully we can talk to you a little bit more about some other ways that we plan to manage this. Slide number 5, for those that are new to hearing about our portfolio construction, we've had a history of doing high conviction managers, right? That allows us to focus on the shop, focus on the core. So you see at the bottom, we have 20 relationships, but 36 funds. And so that has been really good for us because it allows us to effectuate scale, cost savings, and things of that nature. And so several of our managers in our portfolio actually make it to the top 20 of the plan. So the slides you saw, at least 5 of those managers in the top 20 are part of our 6% portfolio. So we definitely believe in high conviction, concentrated portfolios. Next slide. But we still maintain diversification. Even though we believe in concentration, each of our portfolios are significantly diversified. And this slide is probably the easiest one. We could probably stop right after this slide to save some time. But over the last 1 year, we've generated a 22% return relative to our benchmark return of 14%. And if you can look at it since inception, over a 7-year period, 5-year period, 3-year period, we have edged out our benchmark. And then we'll break down what that means by benchmark subcomponent later. But in aggregate, you can see that we've beat it. And I'd say over 9 calendar years, we beat our benchmark 9 out of 12 times. Last year, we were talking to you a little bit about our lagging performance, given that we had a bent towards being focused on that capital preservation. So in a down period, we didn't want to lose as much money. So if you're positioned in a manner that you don't lose as much money in a down period, you don't make as much money in an up period. But working with the treasurer over the last 18 months has helped us position ourselves to be defensive, yet somewhat proactive, because he's allowed us to do what we call a dislocation mandate, and that really helped our portfolio performance out. And so we're going to talk to you a little bit about what that means moving forward. And with that dislocation mandate that we put together, a lot of those funds are starting to come back to us, but we want to reset the clock on the future so that we can be proactive and not flat-footed whenever opportunities come our way. All right, slide number 7. This really breaks down the subcomponents of our benchmark. The blue is our actual performance, and then the red are the benchmarks associated with high yield, leverage loans, and then a hedge fund index. Leverage loans and high yield really comprise what our managers should be benchmarked against, what they can invest in on a long-only basis. And so you can see that over 1, 3, 5, the blue the middle of the blue pretty much supersedes the middle of the red. So that's good. And in honor of saving time, we'll skip to the next. Last thing I want to say is special situations. We do a really good job over a long period of time. And stress, we really do a really good job in identifying good managers. And I'd say in traditional corporate credit and hedge funds, we're probably right at the benchmark there. But those subcomponents have done really well for our portfolio. And if you want to look at the composition of our portfolio, I think you can, on your spare time, look at slide 17 and slide 18, which is in our appendix. And that really shows you what our subcomponents are relative to the subcomponent internal benchmark that we have, or internal targets that we have. Page 8 really shows that we are focused on jurisdictions where the rule of law is important. That's North America and Europe. Biggest risks that I see here on this page is that we don't have enough European exposure. And the reason being is North America and Europe operate on 2 different cycles. So, you want to be in position to take advantage of the lagging European cycle, and you want to be in position to take advantage of cycles in North America and here in the US. So I think, that's one risk that I definitely see. In years past, you would see that European exposure being closer to 20%, 25%. But there are different geographies. Different geographies create different opportunities at different times, i.e. diversification, i.e. a better portfolio performance. last slide that I'm going to talk about is our allocation by GICs. This is the Goldman Sachs sector specifications. And I don't really see any major risk on this slide. We're pretty diversified across all sectors. There is definitely some concentration in financials, but there are a lot of things that go into financials. Real estate could go into financials. Real estate can be in other, but I think we're pretty much diversified across sectors. And I'm going to turn it over to Ty, and he may also rush along as necessary.
Yeah, I'll try to cruise through this pretty quickly. A lot of the credit market update was covered by Jeff. High yield investment grade. I'll get into a little bit more on high yield in a second, but overall, opportunistic fixed income benefited from the everything rally over the past year. Private credit managers did extremely well. They managed through the COVID crisis very well by working with their underlying companies that they loan money to and really helping them out when they had cash crunches. So made it through with really good returns. Structured credit rebounded really quickly after the Fed stepped in, after kind of the COVID crisis. The main area, if you remember a year ago, the area where we were concerned was CMBS, the commercial mortgage-backed securities. They had not bounced back as quickly. We were pleased to see that they did. Lagged a little bit given the underlying portfolios of those investments. So happy there too. High yield, Jeff covered, spreads really narrow. It's actually, while valuations are really high, there is higher debt coverage and lower debt to enterprise values out there. So it's looking okay, but in general, we don't think you're getting paid for the risk that you're taking in high yield. So we've been cycling out of those in favor of some higher quality bank loans and direct loan lending strategies, and that's what we'll get to in a couple of slides. So next slide, 11. You guys saw this already. I thought it was interesting that the CCC, the lower quality high yield spread, is almost down to where the long-term historical average for the broader index is. So spreads are really compressed right now. Next slide. I thought this was pretty striking. This is BlackRock shared this with us, and it shows across high yield, both U.S. and internationally, that yields are at the 0th, if that's a word, 0th percentile since 2010. So just not much yield to be had out there. You may have to rename it low yield versus high yield. And then the next page, we thought this was pretty striking also. 85% of high yield bonds basically have negative real yields. And this was published before the 6% inflation print in October. So it's probably a little bit higher as well. So where do we go, right? And then, so on the next slide, we see about 2.5% pickup in private loan yields. So we think private debt is probably the best risk-adjusted returns right now. We've been focused on that area. We continue to be focused on maintaining those exposures across the portfolio. We think they, while providing more yield, they also provide more structural protections for lenders and a little bit safer. We're focused, top of the capital structure, senior secured, covenants in place, so the safest of the private debt world. And if you, on that second blue bar on that shaded region, if you add a little bit of leverage, you're in the low teens. So that's kind of where we've been focusing money. Ron to talk about some of the opportunities on the go forward.
Yeah, thank you, Todd. And again, slide number 15 really summarizes our priorities for the upcoming year. We want to maintain a meaningful exposure to senior secured loans and private credit. That's really due to the safety. We definitely, as a pension plan, err on the side of preservation, capital preservation, being less risk seeking. And so therefore, this allocation to senior secured private credit loans and even bank loans lends to that. Additionally, we want to continue focusing on SMAs and custom vehicles. These SMAs and custom vehicles allow us to be opportunistic when the time is right. Additionally, they allow our managers to flex from one strategy that's less attractive to another strategy that might be more attractive. In particular, Tom mentioned high yield being less attractive. Well, we have managers that have the ability to move from high yield and rotate into attractive leverage loans and provide that floating rate protection that you have in the rising rate market, or they have the ability to move you higher in the capital structure, where if defaults do occur, if there's an increase in default cycle, you will have higher recoveries relative to high yield if there's a default in a high yield bond. Additionally, we want to revisit our dislocation mandate. It was something that we talked to you all years past, something that we effectively implemented with the treasurer coming out of the March of 2020, April 2020 crisis with regards to COVID. And then given that spreads are low, spreads are tight, a lot of that dislocation money is coming back to us right now. But what we'd like to do is set up these mandates in the future such that if spreads blow out again, we're proactively in position to take advantage of the opportunity so that we're not caught flat-footed, so that we can continue to be one of the shining stars and have good reports to you on an annual basis.
Yeah, I think a lesson on that whole process for not only you guys, but for IG as well too, is like, it's quick. You got to be ready.
You have to have the structures in place before the dislocation comes, because you're a little nervous. I mean, personally, I will be honest with you, March 30, I'm a little nervous about putting money to work, but if you have disciplined, thoughtful things in place, you will do better over a period of time relative to being late, trying to set up structures in the middle of a crisis. And so
I was less nervous buying really high grade companies at very short debts and just your market's a little different than mine.
Plus, you're going to be early. I mean, it's a lot easier to buy on the way down.
Yeah.
Questions? Is there any part of these two pieces of paper that would not forecast that you're going to have a dislocation?
It's a cycle.
I mean, these two things, that's probably never existed, or at least in 10 years.
In 10.
Yeah.
And this is now even worse.
Correct.
As bad as that looks, it's even worse.
People are mispricing the risk of credit.
So having a dislocation strategy in the oven.
If we had that set up, ready to go, so for when stuff did crash. Yeah.
Thank you all. We're now down to our public comment section. I think we have some folks on the hold. And we'll start with John DeVille. John, you have the floor. So John, going once, going twice. Okay. Melissa Chang. Okay. Going once, going twice.
I think there were still folks on the line. So.
Can you hear me? This is John DeVille. Can you hear me?
Hey, John, you have the floor. You have 2 minutes. Welcome.
Okay. Thank you very much. Again, my name is Sean DeVille. I'm a teacher in Macon County. Treasurer Falwell, some remarks that you made in the September meeting of this group really hit me hard. I'd like for you to clarify, if you could, please. You said, quote, that this plan was never designed for people to retire as early as they are. Do you mean to tell me that you expect that educators like myself are going to need to work longer before we can retire? If so, is this a goal of yours, Or is it a plan to save fees by sitting on the plan to save fees by sitting on cash? Is that plan backfiring on you? Thank you.
Thank you, John. Our next caller, Melissa Chang.
We know if she's on the line?
Hi, can you hear me?
Is this Melissa?
Yes.
Yeah, you have the floor, Melissa. Welcome.
Thank you. Good morning, Chair and members of the committee. My name is Melissa Chang, and I'm with the Private Equity Stakeholder Project. North Carolina is an investor with private equity and real estate secondary firm Landmark Partners, now part of Ares Management. Specifically, North Carolina is an investor in Landmark Real Estate Fund 8, which invested in Pretium Partners, the country's second largest owner of single-family rental homes. Since the start of the pandemic, Pretium Partners rental companies Progress Residential, Front Yard Residential, and Havenbrook Homes have filed more than 2,800 eviction actions, many of which occurred while the CDC eviction moratorium was still in effect. In June, NPR highlighted Pretium Partners for filing to evict residents at much higher rates in majority Black counties than in majority white counties, citing our report. Since the start of 2021, Pretium's Progress Residential and Front Yard Residential have filed to evict more than 500 residents in majority Black DeKalb and Clayton counties in Georgia. Specifically, in Clayton and DeKalb counties, Pretium has filed to evict more than 20% and 22% of its residents, respectively. By comparison, Pretium has filed to evict around 4% of its residents in majority white Seminole and Polk counties in Florida. Pretium's eviction practices have also garnered increased scrutiny from elected officials in recent months. In June, U.S. Senate Banking Committee Chair Sherrod Brown wrote to Pretium, noting, "I'm troubled that your companies may have pursued evictions in contravention to the CDC's moratorium. I'm also concerned that these evictions appear to have disproportionately affected renters from minority groups who have suffered greater incidents of serious COVID-related illness and death." In July, the U.S. House of Representatives Select Subcommittee on the Coronavirus Crisis launched an investigation into Pretium's eviction filings. On July 27th, Katrina Chisholm, a Front Yard Residential renter from Georgia, testified before the subcommittee in an oversight hearing related to the investigation. Chisholm, a single mother, lost her customer service job during the coronavirus pandemic and fell behind on her rent. Although she was approved for federal rental assistance, Pretium's Front Yard Residential continued to advance its eviction case against her. Chisholm and her son were ultimately forced to move. Pretium's eviction filings and its disproportionate filings against Black renters in particular have also drawn media coverage by Reuters, CBS, NBC, and Bloomberg, presenting a substantial headline risk. Additionally, Pretium Partners owns several hundred homes and impacts renters in North Carolina. We have reached out to Pretium Partners and Landmark Partners multiple times for an explanation of Pretium's eviction practices. Pretium Partners has not responded in over a year. Landmark Partners has never responded. Landmark Partners is in the process of raising its next real estate fund, Landmark Real Estate Fund 9, and may come to North Carolina seeking additional capital. We believe North Carolina should hold off on new investments with Landmark Partners until the firm adequately addresses its home rental firm's eviction actions. Thank you.
Thank you. Our next caller is Drew Edwards. Excuse me, Mary Beth Murphy from Guilford County. Welcome. Our next is from Drew Edwards, psychologist at.
All right, can you hear me? This is Mary Beth Murphy. Was having some issues getting unmuted.
How are you? You have the floor.
I'm well. Thank you. I appreciate that. Good morning, board and chairman. My name is Mary Beth Murphy. I'm a teacher and an elected county commissioner in Guilford County. I have some questions today that draw on both of these experiences. Specifically, I'd like to ask about decisions of yours that look effectively like tax increases on educators, school boards, and county commissions. First is about the returns that you've given away by not investing $17 billion of our retirement savings. My back of the envelope math is that this could have given every member and beneficiary a cost of living increase with a lifetime value of $8,600, while still leaving us with some funded status as now, with the same funded status as now. Is that correct? And if so, why would you tax our income potential like that and value that has produced for us in exchange. My second question is about your plans to raise funds from counties. Your debt affordability study concluded this January that your decision to lower the bar for investment performance will begin shifting costs onto the state, counties, and school boards next year. You project these costs to grow over 5 years to a $500 million tax each year for educators and state employees. Why should county commissions and school boards have to make up the cost of you lowering your own investment standards? Thank you.
Thank you. Our next caller is Drew Edwards.
Thank you. Can everyone hear me?
We can.
All right, thank you. My name is Drew Edwards, and I'm engaged to an educator, and I'm also a member of the Communication Workers of America. My question is for the Investment Advisory Committee. It seems that the body is the only check on the power of Treasurer Falwell holds over my fiance's retirement and savings. I'd like to get some details on your actual responsibility. Do you have a fiduciary duty regarding decisions like not investing $17 billion of this money? Have you kept informed about foregone returns over time and exercised oversight? Thank you.
Thank you, Drew. Congratulations. Dwight Willis.
I believe he dropped off earlier.
Thank you. We now close the public hearing section, and we'll go around to IEC board members for any closing comments.
I'm just delighted to be in person with everybody. I think our conversations here are far different than some of our peers around the country. I read yesterday that CalPERS board voted to borrow money, which I assume is similar to buying securities on margin in order to try to boost their returns. It's hard to believe that a system is going to be doing that, but very happy for everything that the staff and leadership is doing here to keep us out of that position.
Thank you, Lawrence.
No comments. Looking forward to February.
Lawrence, I was speaking in Charlotte the other day, and when we were talking about somebody who can look into the future, your name came up again as a person. I was in the presence of the many city council members of Charlotte, as well as the past mayor. And I was applauding them for following your lead of 34 years ago and putting money toward the unfunded healthcare liability, which you did in Winston-Salem. And when Charlotte realized what you were doing, they did some of the similar things. And I think Charlotte has about $130 million sitting in that account now. It's not the billion they need for unfunded liabilities, but it's a start. So your name and that decision, important decision on behalf of the citizens of Winston-Salem, as well as others who followed, like the city of Charlotte, continues to live and pay dividends. Good. Thank you.
I've been in this business for 35 years, and the signs are all there, and I'd much rather be in a conservative position when things change. So
thank you.
Thank you all for the right path.
All right, Ben, Mr. Brewer is on. Mr. Brewer is on. Oh, hey, Lance.
Yes, sir, Treasurer. Good morning. I'd echo John's comments. Obviously in this world, we don't have a crystal ball, so we were not in a position to be able to take unnecessary risks. So good job on staff and our guests with the presentations today, and I appreciate everyone's efforts to keep us in the position we're in. Good job.
Thank you, Lance. I want to thank all the board members who joined us in person and Lance by phone. As you can tell, the responsibility of this pension plan weighs heavily on everybody in this room, as well as people who work in the treasurer's office who aren't in this room. So we look forward to meeting you in February. We wish you all a happy Thanksgiving and a Merry Christmas. I've talked in the past to other boards about the concept of the missing place setting. And there are more people who will face that visual reality this year. They're around their holiday tables of somebody who's always sat at the same place who's no longer with us. So however people leave Earth, just be sure to keep all the families in North Carolina, especially those that are in these plans, in our thoughts and prayers as they go through this, for many of them, their first holiday season without their loved ones. So with that, I'll accept a motion. We are hereby adjourned. Make a motion. Sorry. Second. All right, Mr. Patterson. Aye. Mr. Brewer.
Aye.
And Treasurer Fall. Aye. Thank you. We're adjourned.